All right, so welcome back to Mortgage Mom Radio. We gave you guys about 3-4 minutes to, oh, whoops, I got to turn mine down. It's the only way I can see you guys' comments. But we did give you guys a couple minutes for everybody to jump on and join. So I hope that you guys all are ready and eager and want to get this day started. So welcome to the Mortgage Mom Radio Homebuyer Workshop. I am Debbie Marcoux. I am the Mortgage Mom, and I want to remind you guys that this is interactive. So please put your questions and comments into the feed. I would love to be able to read those out loud and answer them for you. We are going to make our way through our PowerPoint deck. I'm going to take you from the beginning of the process all the way through the end. What are certain, what do certain things mean? What are certain words that you guys should know? And all the way to how do you pick a real estate agent and what do you do when you're about ready to close the loan? So don't go anywhere. We're going to be getting this started right now. I want to make sure that you guys are all ready. We do have games if you guys do want to be interactive with us where you can win some Mortgage Mom Radio t-shirts. We've got some Starbucks gift cards and we've even got a free appraisal. So make sure you guys are playing those games with us and you have your phones available to do that and be part of the show. So I could see that Red Muffs had already jumps on. He says, about to be watching from Nashville, Tennessee area. Let's do this. So sounds great. Very happy to have you here and can't wait for you guys to be part of the education. So here we go. Home buyer education. You guys are looking at the very first screen that is in my PowerPoint presented by Mortgage Mom Radio. You've got my name, you've got my licensing. That's all very important because it is important to know that the person that you are working with is a licensed agent or a licensed loan officer in your area where you're looking. That is very, very important. I do recommend that you have somebody with state licensing for your state. So for example, I personally have 13 state licenses. I'm working on 3 more, so I should have about 16 state licenses by the end of this year. And many loan officers will only have 1 license for the state in which they work and they live. So you do want to make sure that you are working with somebody who is licensed in your state. It is very important. Every state is a little bit different. The rules, everything that goes along with the financing can be slightly different from county to state to city. So that is very important. Now, the cool thing about Mortgage Mom Radio, since we are licensed or I am licensed in so many states, we can actually work with you not no matter what, but for a good amount of the nation, a good amount of the country, we can work with you. So we have many clients who have called us and said, try to figure out where I want to go. I might want to be in Texas. I might want to be in Florida. We can help him in both of those journeys. Tennessee, Georgia. If you guys want to have a list of every state that we can help you in, please feel free to reach out. I'd be more than happy to give that to you. So we are going to go ahead and move on to the first PowerPoint. This is going to be something that I want you guys to be aware of. It is a great way for you to be able to communicate with Mortgage Mom. It's a great tool in your tool belt, and we want everybody to have it. I do have Priscilla jumps on. She says, ready to win that free appraisal. All right, Priscilla. And I have Will that jumps in and he says, check in. I'm locally in Las Vegas. Hey, everyone. Hey, Will, thanks so much for joining. I really appreciate that. And we are working in Las Vegas. We're on the radio in Las Vegas and we're doing a lot of deals in Las Vegas. So if there's anything that we can do to help you out, get you pointed in the right direction, get you pre-approved for a loan and get you moved forward to a real estate agent, we would love to help you in your pursuit. So here we go. On the screen, you guys can see that we've got the Mortgage Mom Radio phone app. I do want to make sure that everybody knows that this is a different phone app than the phone app that you will find in the App Store. The phone number in the App Store is when you are doing a mortgage with us, you are live in the process, you have applied for your loan, and that is going to be the way that you're going to upload documents and communicate with us throughout your transaction. The Mortgage Mom Radio app that you guys are looking at on your screen is actually our tool. It's our tool belt. It's our tool app. And this you can only get if you text the word mom to 844-935-3634. You'll see on the screen that it has got amazing features. So you can listen to our podcast. You can watch our YouTubes. You can apply for your loan. You can ask mom questions. It will send an email to me directly. There's a contact us button that will take you to everybody within my team that you can actually reach out to. You can send them an email. You can call our office. It's a great contact app. However, there's more to this app than just that. If you actually see at the bottom, there's a little button that says calculator. That calculator app is amazing because when you go and you look at realtor.com or you look at Zillow or you look at Redfin, any app in which you might be window shopping for a home and you see a monthly payment that is on that app, it is not accurate. It is not calculating the taxes the way that they should be calculated. It is not calculating mortgage insurance if you have less than 20% down payment. If you're a vet or you're doing a USDA loan, it's not calculating the upfront fee that they collect for the mortgage insurance. If you are doing an FHA loan, it's not calculating that upfront financed mortgage insurance. So this app, this calculator is going to do that for you. It is going to calculate the principal, interest, taxes, insurance, and mortgage insurance very, very accurately. It can be off just slightly. For example, if you're doing a conventional loan and you've got less than 20% down and you will have monthly mortgage insurance, we have about 5-6 different mortgage insurance companies that we can shop and we can get quotes from. So I might be able to find you a little bit less expensive mortgage insurance than what the calculator is giving you by pulling directly from the Radian mortgage insurance company. So there's other mortgage insurance companies, and depending on your scenario, we might find you a little bit cheaper. But this is as close as you are going to possibly get without doing a loan application and actually talking to somebody on my team. This is an amazing tool, and I want to make sure that everybody has it. And ding, 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 you're going to need it to play some of the games. So make sure that you guys get it right now. Stop what you're doing. Text MOM to 844-935-3634. You will get a link if you've never texted us before, and it will give you a link to the phone app so that you can save that to your home screen. So with that, let's go ahead and move on to the next screen. All right, so how do you guys contact us? And this is really important because once we're done with this presentation today, you may decide that now's the time. You want to get things started. You want to ask us questions. Let me just tell you that anywhere at all that you look for Mortgage Mom Radio, you can find us. Everything is Mortgage Mom Radio. Don't forget the radio, because there are a ton of people that try to call themselves Mortgage Mom, but Mortgage Mom Radio, you will find us. The website is mortgagemomradio.com. On Instagram, we are Mortgage Mom Radio. You know, you can see it all here. It's on this screen. And if you guys really do enjoy this event today, I would love it if we could get you guys to go to Google and give us some reviews. Remember that this is a free workshop. I'm taking, 3 hours out of my day to do this for you on a Sunday to make sure that I'm educating you and getting you put in the right direction. So I would absolutely love it if you guys could do a Google review for me. That would be really spectacular. Heather did jump on and she says, this is going to be great. Carrie jumped on. Hi, Debbie. Thank you for sharing all this knowledge. Stevie jumps on and says, hello. Another one from Las Vegas here. Thanks for the knowledge, Debbie. Stevie, thank you so much for joining in as well. And I love that we've got somebody in Tennessee, Las Vegas. Love to see somebody jump on here from Washington. My radio program right now is in everything West Coast, Las Vegas, Washington, Los Angeles, and Lake Havasu. So we've got Arizona, Nevada, Washington, everything West Coast right now. And so I love that you guys are jumping on here. I want to make sure everybody knows that we are not just California bound by any means. We are helping people in many different states, and this education is really important for everybody. So here we go. Real estate buzzwords. And this is a big one because I feel like a lot of people get lost in what do these words mean. If you think about the job that you have and the terms that you use, whether you're in air conditioning or you're in construction or you're in the medical field, if you're a doctor, you're using a lot of words and terms and you're shortening things and acronyms that maybe make sense to you and somebody else in the field, but they don't make sense to just the normal person that doesn't work with you. We actually want to make that a little bit easier. We do kind of talk in our own language, and we use a lot of acronyms and we shorten things a lot, and we sometimes use the same word for multiple meanings and multiple things. So I do want to make sure that we go through some of those important words. But one thing I want you guys to realize is that I've got this. It's in this PowerPoint. It is on this screen right now. And this is live on YouTube, which means it's going to be recorded. It's going to stay right here on my channel. And you guys can go back and you can watch this screen. You can pause it. You can read those words as many times as you need. And remember that even after this is over, if you guys have additional questions, you are always welcome to reach out directly to me or any of the girls on my team. And we would be happy to do a one-on-one with you as well to get those final questions answered. Thomas jumps on. He says, hi. Jennifer Sane jumps on. She says, hello all. Priscilla says, best lender I have ever worked with. Love Mortgage Mom Radio from San Antonio, Texas. Priscilla, thank you so much. I totally forgot that you were out in Texas as I'm talking about everybody West Coast. So that's a really good thing. A really good point is that, again, we're doing this across the country, guys, and we absolutely love it. Priscilla is an amazing real estate agent in Texas. So anybody that's been looking for Texas, she is in that San Antonio and surrounding areas, and she's gone pretty far for me in the past. So if you need her contact information, happy to provide that to you. So here we go. Buzzwords. So appraisal, that is something that I think most of us know what that is. You know, an appraisal is going to give us what the value of the home that you are trying to purchase. That is not to be mistaken with a home inspection. The appraisal is not a home inspection. The appraisal is actually telling the bank what they feel. The appraiser is telling the bank what they feel that the home's value is, so that we know that we are not giving you a loan that is too much or over and beyond the value of the home. So a good thing to keep in mind, the appraiser is not a contractor, okay? Closing disclosure. So the closing disclosure, or also known as a CD, is something that you will get at the end of the transaction, typically about a week before you're closing your loan. This is going to have all of the final terms that you've agreed upon: monthly payment, property taxes, homeowner's insurance, the interest rate, all of the fees. You're going to see every fee, if there's points, things of that nature. The closing disclosure is very important, and try to keep in mind that if you are getting ready to close a home and you have not received that closing disclosure, you better start calling your lender, because you need to sign that 3 business days before you can actually sign your loan documents to close on your home. So if things are starting to get tight on time frame and you haven't seen that thing come through yet, or you haven't signed it, make sure that you reach out. Condo review. So you might hear, well, we need to do a review of the condo. Condominiums, if you're purchasing a condominium, we do have to make sure that the complex is in good standing. We do have to do a review of the complex. We do have to look at the CC&Rs, the budget, the insurance, all of those things that are important to make sure that we are lending on a complex that is in good standing, that they're budgeting in reserves in case you guys need to redo roofing or any repairs, or if there's any leaks or any issues that might come to play. So that is what a condo review is. A contingency, you might hear Heather and I talk a lot about contingency. Because contingency is something that is in contracts. It's something that is in every contract across the United States and every state. Contingencies mean that I am going to do X if X. And I think that's the best way to explain it. So if I get my loan approved, I'm going to close on my home. If the appraisal comes in at value, I will close on the home. If my loan is approved, I will close on the home. Contingencies are very important, and you need to understand what the time frames are. So Heather, you guys cannot see Heather actually in the screen right now. She is here because she's going to be doing a part of this presentation when it comes to the real estate. How do you find the best real estate agent? But she will be chiming in for me, so you're going to hear another voice behind
Hi, everyone.
But I want you, Heather, to kind of explain just really quickly how contingencies are important when it comes to their contract.
So there's a couple different contingencies, and I think the first one that most buyers are going to run into is a home inspection contingency. And basically what that is it's a contingency for a buyer to purchase a home contingent upon or subject to the condition of the home. So I strongly recommend as a buyer that you do a home inspection. You ascertain the condition of the property, what's in working order, what might need to be fixed, what might, be on its last leg as a unit or something. And then once you get that, you have the right as a buyer to ask for repairs, ask for credits, ask for things to be replaced. If you and the seller cannot agree on what needs to be done with that item, then you have a contingency in your contract that allows you to cancel the contract and receive your deposit back. Super important. Same thing for the appraisal. If your appraisal comes in under what you've agreed to pay for it, you have the option to cancel the contract and receive your money back. Contingencies are probably one of the most important things in a contract.
Yeah, so you want to have your loan contingency. Make sure that you do get loan approval so that you don't lose the deposit that goes into escrow or title, depending on the state that you're in. Contingencies are very important. You might be a seller. You might be selling your home and buying your next property, and you want your new purchase to be contingent to the sale of your home. What happens if your buyer doesn't perform on your house doesn't close and sell, and now you're locked up into a contract to buy a home that you don't have what you needed from the sale of your property? So that is basically the easiest way to explain contingencies. Contingencies are important. That's just it's a word that we use quite frequently in lending, right? Yes. Excuse me, I got a little bug. Okay, debt to income ratio. So you guys are going to hear that over and over again. Debt to income ratio is all of your income, all of your debts, all of everything, the new housing payment, and what is your percentage of housing payment and monthly debts to your income. So that is something that you'll learn. We can teach you how to calculate that. Docs, you'll hear everybody say, docs, we need your docs. I need your docs. I'm drawing docs. Docs can be used in many, many different ways. Docs are documents. And I know that that sounds funny, kind of something silly for me to have to explain, but docs just means documents. If somebody says, hey, I need your docs, or hey, I'm going to have you sign docs, or can you get that doc back to me? Everything, it's just basically a document. Escrow. So escrow is a neutral third party, and Washington, Nevada, Arizona, California, there are 8 actual escrow states across the nation. And then the other states are not escrow states. Some of them are attorney states, and some of them are not escrow or attorney, but they're dealing directly with title for the entire transaction. However, because my radio show is on the West Coast, I'm going to work with escrow more frequently because that's where the majority of my listeners are. Escrow is a neutral third party. So you're going to think of them as the person that is taking instructions from everybody in the transaction. They're taking instructions from the real estate agents, the lender, you as the buyer, from the seller, and they cannot make a move or do anything without total consent from all parties. So they are going to hold your escrow deposit. When you give your earnest money at the beginning of the contract because you've made an offer on somebody's home, you will be making your money out to the escrow company. The escrow company will be holding on to those funds. They cannot give those funds to the seller. They cannot refund those funds to you. They cannot do anything without instructions from all parties. Now, some people can get very confused. Right below escrow, I have escrows or impounds. Those are totally different. You might hear somebody talk to you or your loan officer explain what is in your mortgage payment, your principal, interest, taxes, insurance, right? Your taxes and your insurance and even mortgage insurance are part of an escrow or impound account. That is totally different than your escrow company that is helping you to close the transaction. So if you want to know a little bit more about how the escrows or the impounds work in your mortgage payment, give us a call. I'd be happy to take you through it. But you can hear that word actually intertwined and commingled, and they really do mean multiple things, but they are 2 different things. So your escrow company is helping you to close the transaction. Your escrow or impound account is a separate account that money goes into every time you make a payment. And when your property taxes or when your insurance is due each year, the mortgage company will pull money out of that trust account and will make the payment for you on your behalf. So totally different. FICO score, I'm not going to get into that. I'm sure you guys all know about credit for the most part. Homeowners Association, the reason I put that there, I think we all know what a homeowners association is, but many times you will hear it referred to as an HOA. Homeowners insurance, I think we all know we need to have insurance in case the house burns down, we have a big flood because of pipe breaks, somebody slips and falls on your property. You do need to have insurance covering your home, but sometimes you'll hear that called HOI. Your loan officer, you might hear it over and over again, the word LO. A loan officer is an LO, or an LO is a loan officer. So just the short term for that little acronym. Your loan estimate or your LE, and you'll hear somebody say, well, I'm going to get you over your LE. I'm going to get you your estimate. Again, same one and the same thing. Your loan estimate is going to look very much the same as your closing disclosure at the end of the transaction, but it is the very best estimate that your loan officer can give you at the beginning of the transaction. It is our job as a LO, as a loan officer, to make sure that we are making that estimate or that LE as close as possible to what we believe that the final product, the closing disclosure, is going to look like. So just keep that in mind. Your loan estimate will look very similar. You're going to get it over and over again throughout the transaction because as a lender, we cannot go and make a whole bunch of changes without telling you. The days of baiting and switching are not it's not viable any longer. It's not allowed. It's not possible. Every single time that we make a correction, we lock in the interest rate. We make a change to a fee. The HOA, so we all know what HOA, the HOA cert, which is what we need to do the condo review, cost more money than what we estimated. The HOA was a little bit more expensive for those pieces. We have to redisclose that to you. The appraiser wants a rush fee. We have to disclose that to you. So you are going to get these loan estimates throughout this transaction over and over again. And it is really important for you to stay on top of those, know what the numbers were day one, and then start to see the changes throughout the cycle, throughout the transaction of the loan. And then when you get that closing disclosure, there should not be very much shock, heart attack. You should feel very, very comfortable and positive about the numbers that you see in that closing disclosure or that CD. Heather jumped on. She did ask a question. She said, are there any words not on our list that you would like to know? Get in the know and ask. Feel free to put your questions here and we'll answer them. So Heather doesn't know when to interrupt me, so she's typing some things in there, and I do want to remind you of that. That's actually a great point, Heather. Thank you so much. Is if you guys have any questions, this is interactive. That's why we have the feed going. That's why your questions are coming through. That's why I can see them. I want you to ask your questions as we move through the presentation. It's very important. All right, so Sunshine and Gardens jumps on. If insurance goes into escrow for the year, is that money part of the closing costs? And that is a great question. And yes, it is. So the way that it works when you are closing your loan is that we require as a lender, not we, not me, I work for a lender that's doing your loan. It is my job as a loan officer or an LO to make sure that you are comfortable and that you understand the transaction. A lender is going to require that you pay 1 full year upfront of your homeowner's insurance policy. Then on top of that, we are going to collect a couple of more months, probably 2, to put into your escrow account. And then every time you make a payment throughout the year, a little bit will go into escrow, a little bit will go into escrow, a little bit will go into escrow. And when that insurance is due at the end of that year for now a new 1-year cycle, the lender or the mortgage company will make that payment on your behalf. So in short, the answer is yes. You're going to buy that 1-year policy up front at closing, and that is part of your closing costs. So again, that was a great question. Thank you so much, you guys. Keep them coming. This is really great. It makes the day so much better because it gets so many questions and so many answers for everybody that is listening and watching. Okay, so next thing is loan to value. So if you hear people say, well, especially somebody maybe trying to refinance, or maybe if you're purchasing, you're going to have mortgage insurance if you don't have 20% down. Or somebody might say, well, if your loan to value is less than 80%, or if your loan to value is 90%. So what they're referring to is how much loan do you want to the sales price of the home. So we're going to take loan amount divided by sales price to come up with a percentage. That is your loan to value, that percentage. So that was a good one. Again, many times we talk in these acronyms and you hear LO, LE, LTV, HOI, HOA, all of these things that I'm showing to you, DTI, CD. It's very important for you guys to just understand what we're talking about. Mellow Roos. Mellow Roos is something that you'll find very commonly when you're looking at a new housing development, newer homes, any home that has been built, I'd say really within the last maybe 10 years or so. You might see that Mellow Roos is an additional tax on top of the standard property taxes for your county, city, or region. And so Mello-Roos is something that you do want to make sure that you are asking your real estate agent as you're looking at homes, does this property have Mello-Roos? Because it is an additional supplemental tax. It is not something that would be part of the base tax for your county or city. And it is something that we want to calculate into your DTI, and we want to calculate it into your monthly payment to make sure that you are still comfortable at that price range with that additional property tax. Mortgage insurance, you might also hear it referred to as PMI. You could hear some people call it MIP. It is mortgage insurance is basically if you have less than 20% down on the home, there will be mortgage insurance in some way, shape, or form. It might not be part of your monthly payment like a VA or a USDA. It might be a conventional might not have it as part of your monthly payment. It might be part of your monthly payment. You can choose to buy it out. You can choose to finance it. You can choose to have it included in your interest rate. But the bottom line is that if you've got less than 20% down, there is a cost for mortgage insurance, and you are going to pay it in one way or another. It is our job as your loan officer to make sure that we are finding the best scenario for you. You're going to hear me say that over and over again, and this show could be a lot of fun if you guys maybe do a new drinking game that's every time that Debbie says the word scenario, you take a sip. We're going to say scenario over and over again because it is true. It is true. Every single person has a different scenario. Every single person has a different credit score. You have different income. You have a different debt to income ratio. You have a different amount of money down payment. You're buying in a different city. Some person wants a single family home over another person that might want a condominium. Every single scenario is different, which is why we have so many different loan programs. And based on you and your scenario, we're going to determine which one is best for you. So just checking my notes here. Priscilla says, Debbie, what's the difference between a conventional and an FHA loan? So Priscilla, actually hang tight because we are going to get into loan programs as we move throughout this presentation. So we will be hitting that one, and that is a really good section. Don't go anywhere. So your physical inspection, I mentioned this earlier today, right at the beginning of these buzzwords. Your physical inspection is where you do want to actually hire a physical inspector or a contractor to actually go through the home and make sure that it is where you want it to be. There's no repairs that need to be done. There's not more work that needs to happen to this home than what you originally expected. Your physical inspection is totally different than your appraisal. So I do want to make sure you guys know the difference between a physical inspection and an appraisal. And yes, you are going to probably pay for both of those before the home closes. I can see you've got something you want to say.
I do. So there's a big misconception that home inspectors have to be licensed contractors. And I want buyers to understand they don't have to be licensed contractors. Technically, in most states, they could be your brother if you wanted them to. But just make sure that when you're hiring your home inspector, it's super important that they are credentialed. A lot of states have specific classes or different credentials that they have to take, but they do not in most states have to be a licensed contractor.
Very good. I like it. See, just when I see you sit up a little bit more, then I'll stop
That's
myself
the
and go,
cue.
what do you got? What do you got, Heather? What do you got? All right. So here we go. So your processor. So understanding that you have a difference between a processor, a loan officer. So your loan officer might say to you, well, my processor is going to reach out, but my assistant's going to call you. So realize that you have your loan officer. They're your main point of contact from the beginning of the deal to the end of the deal. They are helping you structure it. They are qualifying your loan. They are locking in your interest rate. They are determining with you what is the very best loan program for you, for your scenario, if you guys are playing that drinking game,
Dang it.
right? There goes Heather. She's taking a sip of her margarita. But just realize that you have many different people. There's your underwriter, which is going to be on page 2. You've got your processor that's going to work directly with your underwriter. You've got your loan officer's assistant who's going to work directly with your loan officer. So these, again, I'm just kind of showing you all of the different words. And if there are words that you have questions about, you've heard somebody say, you don't know what it means, if you're listening to me right now, go ahead and put that in the feed and I'll answer that question for you. And if not, you guys have all the different ways to contact us. Reach out to me, questions@mortgagemomradio.com, the contact us button on my website. Just make sure that you reach out, you get me or get one of the girls, and we'd be more than happy to answer every question that you might have today. So property taxes, okay? I'm not going to go deep into this, but what are property taxes? Property taxes, everybody that owns a home is going to pay property taxes. And that's just, we all know how it goes, property taxes. Real estate agent versus a realtor. And I know that this is going to be something that Heather will talk a little bit about when she gets into her, how do you go about finding the best real estate agent for you? Why would you want a real estate agent versus a realtor? I'll let you do a 30-second.
Basically, the biggest difference is a realtor is a member of the National Association of Realtors and also their state and local boards, to where a real estate agent is simply somebody who has a license. You want that person that's credentialed with NAR.
Yeah, there you go. So make sure you guys are looking for a realtor, not working with a real estate agent. Your termite inspection. So your real estate agent or your realtor is going to recommend whether you guys do a termite inspection, whether you don't, whether you want to have one done, whether you don't want to have one done. It used to be for many years in the state of California that the seller would pay for the termite. It is now switched. And in California now, if you are a buyer, this is an additional inspection that you have the right to do. So you're actually paying for it and ordering it. So it is truly your choice. Again, every state, every county is different. So it depends on your state where you are living, the contract that is being written, what would be standard and what would not be. But a termite inspection, I personally think, is a very important inspection. You do want to know, is it time to get the home tented? Do we just need to do a little bit of work? Do we have some dry rot that we could maybe clean up? The eaves on the property, get it, sanded down and repainted. I personally believe that that's actually a very important inspection that you guys should do, but it really does come down to you as the buyer to choose to waive it or to have it taken place. And then your title report, guys. The title report, this is your prelim. You'll hear it referred to the two different words. It's one and the same thing. It can be commingled, but this is very important because this is going to show the lender and you as well, the buyer, if there are any liens against the property. So does your seller, the person you're buying the home from, have a mortgage liened against the property that we need to make sure that we get paid off? Are there any IRS liens against it? Is there a mechanics lien? Has somebody else put a lien against the property that you need to be aware of prior to taking ownership of the home? They're also the title insurance company is ensuring that you are going to have a free and clear title. There will be no liens at the time that you take possession, that it becomes your home. The lender that you are doing your loan with will be putting a lien against title. So we want to make sure that we are in first position, the only lien against your home when we are giving you that loan against your property to buy it. So your title insurance is very important. There is a lot of really good detailed information in your title report, and you do want to make sure that you read through that when you receive it. Many buyers will get it. Many real estate agents will get it. Quite frankly, many loan officers will get them and not pay attention to them, not really take the time to stop and read what is there. And it is something that is very important to be reviewed and looked at. It also will give you all of the property taxes that are assessed against the property. There's a lot of great information in that preliminary title report, title insurance policy. So make sure you guys do take a look at that. And your underwriter, I think that's pretty self-explanatory, but she's the girl making the decisions, or boy, man, woman, whoever it might be, they're making the decisions. So it's our job to make sure that we are putting together a file in which we know is going to go smooth sailing past that underwriter's desk. And so that is where your loan officer comes in and does the best that they can. So this is where we are going to do a contest if you guys all want to participate. It's really very simple. You guys are going to open my phone app if you have it, not the app from the App Store, but the one that you guys got earlier today when you texted the word mom to 844-935-3634. You're going to text the word mom. That's how you get that app. But if you've got the app, you're going to open it up right now. You're going to click on Contact Us. You are going to find or click Email Heather. And then in the subject line, you are just going to put your first name and hit send. That is it. All I'm trying to do is get you guys comfortable using my phone app. And for this, we are giving away a free Mortgage Mom Radio t-shirt. Whoever is the winner will be able to tell me what size that they would like. On Monday, when my assistant Jenny is in the office, she will contact you. She will show you pictures of the t-shirts that you can choose from. She will get your size and she will get that shipped out to you. So once again, again, open the app, contact us, click email Heather, and in the subject line, put your full name and hit send. So as soon as we get one person to do that, do you have one yet? Okay, as soon as we have one person that does that, we will email you back to get all of your information to contact you on Monday, but I will also make that announcement right here during this show. So also keep in mind, we're doing many contests, guys. We've got like 3 contests. The next one is going to be $50 Starbucks cards that were generously donated to us from Go Country 105. There is going to be an opportunity to also win a free appraisal. So make sure that you guys are staying active, staying live, and staying interactive. All right, so we are going to here take a super quick break because quite honestly, I need a little sip of some water, maybe a little margarita. It's going to take about 20 seconds, so don't go anywhere. And then we're coming back and we're going to get into the next PowerPoint piece, which is home values. All right. And oh, it looks like Wendy Bacchus, you are our winner of the first contest. So we will make sure, Wendy, I've got all your information. We have actually emailed each other before. I will make sure that my assistant Jenny reaches out to you and shows you the t-shirts that we have so that you can pick the one that you like the best. So stay tuned. Super fast break. I just need a quick sip and we'll be right back. All right, so welcome back to Mortgage Mom Radio. We're doing our Homebuyer Workshop today. I hope you guys are loving it. I did see a response come from Mom on the Go. I love your screen name, by the way, Mom. Yep. Sorry, didn't get the link. Janice also said I texted Mom but didn't get a response. So if you guys have ever texted or received a text message from me before, it might not send a direct response. Heather is going to actually put her personal cell phone, since she's sitting here in the studio with me. She's going to give you her personal cell phone number right now. And please text her directly. Just say, hi, this is Janice. Hi, this is Mom on the Go. And she is going to share with you directly the link so that you guys can get what you need. So make sure that you guys text her and she'll get you taken care of. It. Anybody else that might have had that same problem, just go ahead and text Heather directly right now. She will share the app with you so that you can get it right away. All right, so why do I have Seattle, Tacoma, Bellevue, Metro home values on the screen right now? Okay, so like I mentioned a little bit earlier in the show, right now, the radio show itself on radio, we are in Seattle, we are in Las Vegas. So Las Vegas, hey, we're going to get to you guys too. Havasu, Arizona, Los Angeles. I think it was really important to just kind of get an idea, as we're all buyers here. We're all trying to kind of figure out what we're doing. I thought it was nice. What I actually searched was, what is the median sales price of homes in and then the area. So I just thought this was kind of cool for you guys to see, just sort of a overview of information. So Seattle right now is at an average price, and you can read what it says. This is straight off of Zillow. The typical home value of homes in Seattle, Tacoma, Bellevue Metro is $793,263. This value is seasonally adjusted and only includes the middle price tier of homes. Seattle, Tacoma, Bellevue Metro has home values have gone up about 21% over the past year. So I just wanted to kind of give you guys sort of an idea. Obviously, if you're outside of those areas, you're more, southern Washington, Kennewick, Pasco, you're going to have a totally different average median. This is not to say that this is the price that you guys have to be pre-qualified for in order to buy a home. This is median. So remember that there are homes that are less expensive than this. There are condos, townhomes, things of that nature. I just thought that it was kind of cool information to share. And the same, here you go, Las Vegas home values. Your median price right now in Las Vegas is $440,000. I'm kind of loving that number. They've gone up 32% in 1 year, property values have appreciated. So that was actually a pretty big number. But I actually like that number. I've been trying to figure out where I might want to move that things are a little bit less expensive than here in LA. So Las Vegas, I might have to check you out. All right, Los Angeles County. So 882,000. And I went with county, and anybody that actually lives in Los Angeles or Southern California understands that if I put Los Angeles, like the city of Los Angeles, that is not at all Los Angeles. Los Angeles is huge. It encompasses a very, very big spread area from honestly the tip of, the beginning of Orange County all the way down, to Fraser Park and all the way to, Palmdale is Los Angeles County. It's very, very big. It's very diverse. So this was the average median home price throughout the county. Obviously, if we go into San Bernardino, Riverside, those are going to be this number would be much lower. And I encompass the entire county because we have a lot of areas where you can still find very affordable pricing. You're just not right in the heart of, downtown Los Angeles. So again, this was just great information I thought would be cool to share, and I wanted to make sure you guys saw it. So now we're going to talk about what are the benefits of homeownership. You guys are on here at the moment. We've got about 19 of you watching. We started off, we were probably at about maybe 25 or 26 people. And so this is going to go on throughout, right? People are going to jump on, jump off, jump on, jump off. So it's going to stay probably pretty steady with about that number that you see. You're all here because I said, I'm doing a homebuyer workshop. Jump on for the workshop, educate yourself, learn. So let's learn. Why are we learning today? What is important about today? Why are we doing this workshop? It's the benefits of homeownership. What are your benefits of homeownership? And trust me, I'm going to actually take you through what are your responsibilities of homeownership, because that is important, right? So the benefits of homeownership is, number one, that you're going to build wealth. When you own a home, over time, and people can argue all day long, well, property values are going to drop, aren't they, Heather? We're going to see a big crash. They're going to take the rug right out from underneath of me. Okay. Over time, property values go up, property values come down. It is a cyclical cycle that goes around. And every time that it goes around, it's going to stop at the top, and then it's going to come back down again, and then it's going to go and it's going to surpass its top, and it's going to come back down again, and it's going to surpass its top. I want to make sure that everybody on here understands that real estate is for the long haul. Unless you are an actual real estate investor, what you do is buy homes, quick flip, buy homes, real estate, rentals. You're some sort of actual investor in real estate. The majority of us, including me, I work in this industry, but I don't do that. I am an actual person working a job, making money, paying the bills, making my mortgage payment. I am not an investor. I'm not a real estate investor. So it is for the long haul. It is not a quick flip. It is not a quick buck. That is what you guys all have to understand, okay? But you will build wealth. If you own that home and you continue to own that home, you are building wealth. You are going to get tax savings. You can see on the screen, I have your 1098 that you're going to receive from your mortgage company at the end of every year, and it's going to show you how much did you pay in mortgage interest over the last 12 months. That mortgage insurance, as well as your property taxes, are tax deductible.
Mortgage interest.
Sorry. Mortgage interest. Your mortgage insurance is actually tax deductible at this moment as well. Mortgage insurance was tax deductible, then they took it away. It wasn't tax deductible, then they put it back. Now it's tax deductible again. But mortgage insurance, that is your PMI, but your mortgage interest is tax deductible. Your property taxes are tax deductible. Your mortgage insurance as of 2022, well, I need to take that back. As of the 2021 taxes that you file is tax deductible. So we don't know what tax laws and changes will come into effect in 22. Just realize that mortgage insurance has actually gone back and forth many times of being deductible and being not deductible. So that might help you to kind of decide which loan program or option that you might choose. Okay. Tax savings security. Okay. Nobody's going to knock on your door and serve you with hey, I need you to move in 30 days. Your contract is up. Our agreement is over. I'm going to sell the home. So sorry, so bad. This is horrible, especially if you have kids and they're in an elementary school and you're trying to stay within a school district and nobody wants to move unless they're ready to move. And so the security of knowing that if you make a payment, you make your payments, you pay your taxes, you are not going to lose your home. You have that security of that is your home. Those are your roots. You are putting down your stake, your place in time. So the security is really great. Pride of ownership. So think about, you're a renter, you hate the carpet, you wish that the countertops were different, you'd love to put in some landscaping, it's all nothing but grass, and the bushes that are there, they're rose bushes, they're bringing you bees, you hate them. Whatever that it might be, the pride of ownership is amazing when it comes to home ownership. You can do whatever you want to your home to some degree. Now, if you buy a home in a homeowners association or an HOA, you're going to have to actually live by their rules. But when you buy that home, you're signing up for it. You're agreeing to their rules. So just keep that in mind. But for the most part, you can change the inside. You can put in the floors that you want. You can paint your walls the colors that you want them. You can plant what you want to plant in the backyard. Every hard-earned dollar that you put into your home makes your home better. It improves it. And it's pride of ownership. You get to put your personal touch on that property. And then you're going to build good credit. Most of the time when you rent a property, your rents don't show up on your credit report. They're not part of your payment history, even though you're making that payment every single month. So when you do have a mortgage on your credit report, it is getting reported to the credit bureaus, and you are building more credit. And trust me, when you go to get other types of loans, they love to see that you have a mortgage. If you're looking for an RV or a boat, or maybe going to buy an investment property, you want to go get another second mortgage payment, the lenders that are offering the financing for whatever it is that you're looking for, they love to see that you have home ownership. They love to see the mortgage payments. And many times you'll actually see your credit score improve after you've got, 6 to 8 months worth of mortgage payments reporting to your credit report. So that is definitely a positive or a benefit of home ownership. Okay, so this next one is rent versus own. And I wanted to actually show you guys what I put in, and you can do this all on your own at home if you want. This is on Zillow, so I made sure that I put the link on there because I don't want anybody to not know where I got information from. But if you go to Zillow and you put rent versus own calculator, you can actually see what the benefits are. How long would it take for you to actually be in the positive purchasing a home rather than being a renter? And many times, I'm going to actually click really quick and then I'll go back. I'm going to show this slide to you that you guys are looking at right now that shows you that after 4 years, buying is actually cheaper than renting. But nobody knows how I got to that. I could totally change this, and you could see 2 years, 3 years, 1 year. I could manipulate the information. So today I decided to show you guys how did I get to that graph to see where did that 4 years come from. So you can see on the screen, it asks me for the annual renovation cost rate. So, how much are you guys going to put into renovations into the home over time? And renovations can be anything from a broken toilet, you had to replace it, to having to maybe make a roof repair, to having to replace an appliance, putting in new carpet, right? On average, if you average out over time, what your costs of homeownership are going to be, $3,500 kind of seems to be a going standard when I do some research and some Google search. So I put $3,500 into that calculator. Your renting utility costs. You guys can change this based on where you live and how much you pay for utilities. I put $600. I actually thought for here in Southern California, unless the person that you're renting the home from has solar on your home, you're paying way more than $600 a month in utilities between all of the utilities that you will pay. Your gas, your electric, especially if you're actually renting a single family home, your trash, your water, your gas. I mean, it's just, trust me here, utilities are very, very expensive. But I went with $600 so that I would kind of average out throughout the nation. I don't want anybody again to feel like I'm not catering to your neighborhood or your area. You guys can go to Zillow and run this one for yourself and see where your numbers put you at for rent versus buy. So your rent broker fee, most of the time as a renter, you don't pay the broker a fee most of the time. So I put 0. Again, I was trying to make this a worst case scenario. How long could it possibly take to be in the positive from buying versus renting. And so I put all the worst case scenarios in here, right? 0 broker fee. You didn't have to pay for one. Renter's insurance costs. So I used $50 a month. That's about average for what you'd pay for insurance on all of your own personal belongings. Most apartment complexes and most renters, landlords are going to ask you as a renter to get that insurance policy. I put an HOA fee in here of $50. So that's assuming you buy a single family home and you've got a very, very small $50 HOA fee. There are many homes that are not in HOAs that you would not pay any HOA fee at all. I did make this based on a single family residence. I did not make this based on a condominium. So again, your personal scenario, take a drink. And Heather's got her margarita over here for real. So she's like, geez, I'm doing it. But you know, if you're looking at a condominium, run these numbers for yourself to see where you pan out, right? Annual property taxes, I used 1.25. Many areas, like I was just looking at Utah a couple of days ago, they're like 0.58. Arizona is like about 0.71. Las Vegas, you do tons of Vegas. What do you usually see on your Vegas?
Actually, you know what? Vegas isn't a percentage that stays with the home. So as the home gets older, it actually goes down. Some of them pay like $50 a month in property taxes. It's awesome.
Yeah. So you have to do this again based on you and your scenario. Okay. So, but I put in worst case scenario, right? I put in super high taxes, Los Angeles County, maintenance rate. So again, I put in another $3,500 because you still need to maintain your property. Selling costs, I put in 8%. Most people will not spend 8% to sell their home. So this is assuming that you buy a home and then you're going to turn around and sell the home. So I used 8%, which is a huge percentage. That is usually, I would say, closer to like 6%. So I put first year home value forecast, 0. Everybody that is on here has been thinking, should I buy? Should I wait? I guarantee you, if you've been thinking about it in your head. So everybody's worried. Oh my God, housing prices are coming down. We're going to have a recession. We're going to have this major crazy blowout. So I put 0 in appreciation over the next, for the first year. First year's rent. Well, hey, guess what, guys? Rents are going up, and we're seeing them go up by about 10% right now per year, which is huge. You guys are going to see massive rent increases. They're on their way. An investment rate, I put 0, nothing, 0. What is the comfortable home price? I did this based off of a $700,000 purchase. I was kind of gearing it towards Seattle a bit. How much is your down payment? I put a minimum down, 5%. What is your rent monthly? I put $3,800. I have a feeling that a $700,000 property, single family home in Seattle, in Los Angeles, is $3,800 plus per month. But that's the number that I used. So with all of those numbers, you can see that after 4 years, so taking into account the money out of pocket for down payment, the money out of pocket for closing costs, the maintenance fees, all of the things that go into owning this home, after 4 years with 0 appreciation, you are actually in a better place than if you were to rent. Renting costs you more money. So why would you guys want to be on here today learning how to do these things? This is why. Check it out. Do your own rent versus own calculator based on you and your scenario, and figure out which one is, does it make sense for you to buy.
I think you're doing it on purpose now.
I am doing it on purpose. I'm going to just keep saying it over and over.
Stay tuned till the end of the show when Heather's margarita's gone.
I love it. I bought you 2, so you're good. All right. So Sunshine and Garden says, if currently pay $2,000 a month, does that mean I can qualify for the same amount in a mortgage? So to be honest with you, that's a really hard question to answer, because many times, like if you are with just a personal landlord who is renting out a home that they own, it's not an apartment complex, it's not a big investment firm. Many times they don't dig really deep into your income and how much earnings that you make. So I don't know how you qualified. I don't know what you saw, what you showed when they approved you for that rent. So no, it doesn't necessarily mean that if you can afford $2,000 a month in rent, that you can qualify for $2,000 a month in a mortgage payment. But let me actually leave you with this. Many times people qualify for more in a mortgage payment than what their comfort level is in a monthly payment. They can get pretty aggressive in what they allow in qualifying debt ratios, which means that you can usually qualify for more than what your budget feels comfortable. So if your budget is comfortably at $2,000 a month, the chances of you qualifying for that, as long as your income is that's normal and we can, document it and all that good stuff, is probably pretty good. Best way to do it. But again, every single person is different. We've got to see your all of your income and your application and all of those good things. It's very important for us to do that. Okay, so all right, my dad's leaving for work. Thanks so much, Dad, for coming in and watching. Appreciate it. Heidi says this is great. Heidi, thanks so much. I appreciate it. If you think of a really good question or something that that you get quite frequently from the clients that we work with, throw that into the feed so that I can make sure that I throw that out there and I answer it. So your annual property tax bill. So now we're going to talk about your responsibilities of homeownership. It's very important to understand that with all of the benefits of homeownership, which there is a ton, you also have responsibilities, and you are now responsible for a property. This is yours. You own it. So you need to make those on-time mortgage payments. Just like that mortgage can help your credit report, it can actually hurt your credit report as well. If you don't make mortgage payments, that will get reflected on your credit report. A mortgage late will kill your credit score. So you want to make sure that you guys are making payments on time. Your property taxes are due. You have to make sure that those are paid. If your mortgage company is not making the property tax payments for you, you're making them on your own. It is very, very important that you're budgeting for them and getting those paid. The city or the county, whoever you owe those taxes to, if you get behind, if you get delinquent, they can foreclose on you, just like a mortgage company can foreclose on you. So the last thing that you want to do is get behind and end up losing your property. Your insurance is very important. If you don't stay up to date, you don't make those insurance payments, you don't make sure that you've got the right coverages, then you could end up with a problem. If you're having a birthday party and somebody comes over and they slip and they fall and they hurt themselves and they're suing you and you don't have the right coverages, maybe you let the insurance lapse, you didn't get that insurance paid, and you have no insurance, you could really find yourself in a position where you can't afford the lawsuit and bye-bye home property. So it's very important that you know that the homeownership responsibilities and that you are making sure that you are on top of those and taking care of them. One of the easiest ways to stay on top of them and take care of them is, like we talked about in our buzzwords, with impounds or escrows in your monthly payment. You never have to worry that your taxes aren't paid. You never have to worry that your insurance isn't paid. You are, as long as you're making those payments on time. Now, your HOA dues are very important. Your repairs and maintenance, we talked about it. Obviously, you want to make sure you're staying up to date with that. But your HOA dues, a lot of people don't realize this. If you get short one month and you make the payment to the mortgage company, but you don't pay the HOA, you can't just let that keep going, even though it's not reporting to your credit report. An HOA, or a homeowners association, as we learned in buzzwords, can foreclose on you. Did you guys hear that? Can foreclose on you for not making your payments to them. So again, know what you're signing up for, understand what you're responsible to do, and make sure that you guys take care of them. So we're in contest number 2. So I'm going to let you guys do this while I take a very short break again, so I can get a little bit more water, maybe a little margarita. So we are going to go to your Facebook or your Instagram. I don't care which one. You're going to find my page on either one of them, Mortgage Mom Radio. And I want you to either like me or follow me, depending on whether you guys like Facebook or you like Instagram. The first person that pops up on my feed is a new follower or person that liked my page. I'm going to announce your name in just a bit, and you guys get those $50 Starbucks gift cards. There's actually 2 of them. So stay tuned. We're going to take a super quick break. You guys do this, and we'll be back in about 30 seconds. right, so welcome back to Mortgage Mom Radio. I'm Debbie Marcoux. I am the Mortgage Mom, and today we're learning all about homeownership. I did see we're at contest number 2. I told you guys to go to either Instagram or to Facebook, whichever one is your taste, and to make sure that you like or follow. And it looks like Yolanda Barba, you followed me on Facebook, and you are the first one that popped up. I had some actually, like, literally it went during the break. Becky Schrager, thank you so much for also doing that on Instagram. So I will make sure that I get a gift card off to you, Becky, and we'll make sure that we get a gift card off to you, Yolanda. So I want to make sure that everybody is having fun today and that you guys are enjoying the day and the show, and you guys are learning and getting all of the information that you need. So Heidi did jump in because I had asked her, I said, hey, is there something, that you get questions a lot that you'd want to ask or tell me to answer or whatever? So she says, supplemental property taxes, even when impounded. Okay, I like that. And she didn't even have to tell me what it was.
Great question.
It is. So one thing to keep in mind, guys, is that when you buy a home, your property, and this is, again, not every state. Vegas is different. Nevada's different. You actually take over the property taxes for the home, whatever those might be, and they don't actually reassess them based on sales price. In many states, though, they do. In many states, your property taxes are assessed based on the sales price that you buy the home for. When you are closing your loan officer is going to do the very best that they can to estimate what they expect your monthly payments or your annual property tax bills to be, and then obviously divide that out to figure out what they should be putting into your monthly payment to make sure that they're collecting enough to get those taxes paid. However, the county will then go in after you're an owner, and they will reassess your property, and they will send you what's called a supplemental tax bill. You will only get this one time, and they'll usually break it into a couple of different payments for you to make, but it is a one-time payment that does have to be made. And what it is it is giving you the difference between what your seller property tax bill was and what your new property tax bill is. And what you have to keep in mind is that the taxes that you were paying between the time you closed your house and the time that the county gets the reassessment done is based on the seller. So when your taxes do go up and you owe more than what your seller did, then you're going to get that supplemental bill. That is not part of your escrow or your impound account, and you do need to be prepared to make that payment to the county. So if you have more questions about supplementals, that doesn't make sense, I didn't explain it thoroughly enough, again, please reach out, ask your questions. You guys know how to get a hold of us. Instagram, Facebook, my website, call us, the telephone number, email me, however it is that you feel comfortable reaching out, please do that. Me, Heather, Heidi, Carrie, Cindy, Jenny, Manny, we're all going to answer whatever question it is that you guys might have. We're here to do that with you, to give you guys that education. Okay, so on to the next part of the presentation. How do we determine what program or which loan program is best for you? How do we make that decision? I'm sure you guys have all heard FHA, VA, USDA, conventional, jumbo. You're like, okay, well, how do I know which one to pick? So we're going to kind of quickly go through that really fast. What do we usually look at when trying to decide what kind of borrower are you? Which loan program makes the most amount of sense for you? So your income and your budget is number one. We want to make sure that we're getting you into a comfortable monthly payment. That's basically in your debt to income ratio. You guys can read all of the rest of the things that I have on this, in this, your income budget 1 through 5 kind of makes sense. We're going to make sure that we're structuring a payment that's comfortable for you. We're going to make sure that we're talking about your tax basis. How might your W-2 change? How might your withholdings from your monthly, weekly, semi-monthly paycheck be changed now that you've got the write-offs that we talked about with the benefits of homeownership? We're going to go through all of that with you, but how do we determine the best loan program for you? Couple of things is, what's a comfortable monthly payment? What's your debt to income ratio? What is your credit score? How much down payment do you have? What kind of property are you buying? Are you claiming income? Are you self-employed? Are you writing it all off? Do we need to do an alternative docs situation? We're going to go through you and your scenario, Heather.
Oh, man.
we're going to go through you and your scenario. Are you getting a gift for your down payment? Do you need closing costs from the seller? There's all kinds of things, and you can read every single one of these bullet points that I have on this PowerPoint, on this spreadsheet, that are going to determine which program is going to work best for you. Now, I'm going to break that down a lot tighter in this next section.
At least you didn't say scenario is best.
I did not. We are going to break that down. We're going to get a lot deeper into each kind of loan program. So as we're talking about the loan program and the benefits of the program, you could be thinking about yourself. Does this one sound like this is my fit? Does this one sound like this is my fit? And again, you guys, it's an interactive show. Please feel free to throw your questions into the feed as we go along. If I say something that doesn't make sense, tell me to stop and to explain it again. I am more than happy to do that.
Remember, Priscilla did ask a question, I think, about conventional and FHA.
She did, which is this is where we're going right now.
Perfect.
We're going into loan programs. Priscilla will be able to see the differences between conventional and FHA. So we're going to actually get into quite a few of them right now. So we are going to start with VA. And what I do want to do, I'm going to take a second and I'm just going to ask, we've got about 20 people watching the video right now. Of the people that are on at the moment, are any of you vets? And I don't even care if there is one of you that is a vet. Are any of you a vet or vets? And I want you to just quickly throw a yes into the comments, because this will help me to determine if, while I've got all of you here on a Saturday doing this workshop with me, do we want to spend the next 7 to 10 minutes on a VA loan? So go ahead and throw that into the feed for me, a yes. And I'm going to give this just a second. Mikey, go ahead and run like about 30 seconds worth of just a quick commercial break. And if I don't get a single yes, I'm going to not go through this piece through this PowerPoint. But if you are watching the video later and you are a vet and you want to know more about VA loans, you just go ahead and you call us directly. It's 844-935-3634. We will take you through the PowerPoint, you one-on-one, about your VA status. So go ahead and run those, Mikey, and then we'll start back up. Hi, I'm Debbie Marcoux, host of the Mortgage Mom Radio Show. And today I've got Heather Barkley Kilpatrick with me so that we can present to you today's Mortgage Mom Radio feature. Okay, and we are back. So during that time, I did not get... Hi, I'm Debbie Marcoux, host of the Mortgage Mom, that they wanted to know about the VA loan program. So we're going to go ahead and go right past... Hi, I'm Debbie Marcoux, and move on. So I'm just going to go super fast, bunch of clicks. There's no reason to do VA if we don't have anybody watching right now that's interested. So here we are, FHA. Okay, guys, so we're going to go through FHA. So FHA gives you a 3.5% down payment in most situations. Remember that this can change just a little bit if you actually have, if you are buying units, then there could be a larger down payment required if you have a non-occupying co-borrower, so somebody that's just co-signing for you. But in the majority of transactions, 3.5% down payment would be for FHA, which is fantastic. FHA is much more lenient on our credit guidelines surrounding bankruptcy, even previous foreclosures. I like to call FHA sometimes the do-over loan. FHA is very commonly known as our first-time buyer loan. Your credit scores do not have to be super high. You could have had a foreclosure or short sale. You could have had a bankruptcy. You can have collection accounts. It really helps many people who maybe didn't think that they had the opportunity for mortgage lending get into a home. So I love FHA loans. I truly do. Gives you a much higher debt to income ratio. They allow a much higher debt to income ratio than a conventional loan might, or a jumbo loan might, or a USDA. The only program that will typically go even higher than an FHA on the debt to income ratio would be a VA loan. And but other than that, which most you have to be a vet or in the service to get your VA loan. There's more people that don't have that ability than do. And so FHA is a great, great product when we're trying to maybe push the envelope. We obviously don't want to put something into someone into a home that they can't afford. But let's just say, for example, you are going to have a roommate. You and a roommate rent an apartment today together. You split the rent. You really want to go buy a place. They're going to come and move in with you. They're going to keep paying you rent. All right, so we don't necessarily have their income to help you qualify. We can't use their rental income to help you qualify for the room that they're going to rent. But we know that you're going to be comfortable in making the mortgage payment either way. So in that situation, FHA is going to give you a higher debt to income ratio than any other loan program would, helping you to qualify for just a little bit more house. The mortgage insurance premiums can be lower than other loans, such as a conventional loan. It really truly depends. Sometimes conventional has a lower mortgage insurance premium. Sometimes it has a higher. If you have a lower credit score, and I would say anything 680 or below, you are most likely going to end up with a less expensive monthly mortgage payment with an FHA loan than you would with a conventional loan. The mortgage insurance will be a little bit less expensive, and the interest rate will be a little bit less expensive. So keep that in mind. When you do own a home and you want to do a refinance, you can cash out. You can do a cash out refinance up to 80% of the value of your home. Or if you guys learned what LTV meant, if your home is worth $1 million, you could do a loan up to $800,000 with an FHA loan taking cash back. So if you owed $600, we did a loan for $800, you could actually get $200,000 cash in pocket. So that's pretty cool. And then we've got streamline refinance. So FHA is very cool in the fact that it will allow you to do a streamline refinance later. So let's say, for example, we put you into a home today and the interest rate is 5% or 5.5%. And then all of a sudden the interest rates come down and they drop to 4% or 4.5% or 3%, right? We can do what's called a streamline refinance with an FHA program. This is not available on a conventional, not available on a USDA. It is available on a VA. So VA and FHA have what's called a streamline refinance program where we can actually drop your interest rate and drop your monthly mortgage payment, and we don't have to barely do anything. I don't have to collect pay stubs. I don't have to do an appraisal. It really makes it very, very simple. We're going to verify that you work, that you're an active employee where you're at. And as long as the monthly payment is dropping and you've made your mortgage payments on time, many times we don't even have to pull credit. So a streamline refinance is pretty cool, and that is definitely one of the benefits of the FHA program. So Carrie did jump on. She says hi to Janice and Becky. Thank you for watching. Mom on the go says hi, Carrie. So that's pretty awesome. And then Heidi says, I get the question, so I have to be a first-time buyer. And no, you do not have to be a first-time home buyer with an FHA. Many times it is related to or referred to a first-time buyer program, but you do not have to actually be a first-time buyer to get an FHA loan. So good question, Heidi. Okay, they are, I already said this, typically a lower interest rate on an FHA loan than what would be on a conventional. So some of the benefits, you can have a lower credit score. The mortgage insurance would be cheaper than it would be on conventional if you have a lower credit score. You can actually have a lower interest rate than what it would be on conventional, and that is all of the time, regardless of your credit score. So FHA does have some perks and has some great ideas and some great, things. So just want to make sure that you guys know what an FHA loan is. You can qualify for a little bit more than you could with FHA. It really is a great program. All right, so I have Wendy jumps on and she says, if you are going to get an FHA loan because you don't have 20%, does it make sense to just do the 3.5% down, or should you put more down if you can? So Wendy, to be totally honest with you, it really depends. It depends on what you're trying to budget. What monthly payment do you want? What kind of, loan are you getting? Maybe you need to put more money down because you're trying to achieve a certain budget monthly. Maybe you can afford the payment with the 3.5% down. And in that situation, no, I would not put all your money down. There's other things that you can do with your money to also be giving you dividends and returns. So really it comes down to you and what makes sense for you and how much do you need to put down to qualify, things of that nature. Great question, though. I love it. And you guys, keep them coming. This is amazing. Loan limits on FHA will, depending on your area, go up to as high as $970, $800. That is the high cost area. That is Los Angeles County. We see that in Orange County. Seattle's is high. It is not quite that high, but it is pretty darn high. It depends on where you are, and what the cost of living is determines what the FHA loan limit is. So you would have to give us a call to find out what your area is and how much of a loan can you get where you're looking. FHA is also awesome because we do not have any reserves required. And so a lot of people ask me, well, what are reserves? Some conventional loans, most jumbo financing products, many alternative loans such as bank statements or investor loans are going to require that you have reserves. Reserves are based on the total monthly payment. So your principal, interest, taxes, insurance, if there's mortgage insurance, if there's HOA, if there's lease, sometimes there's a land lease, everything that would be incorporated into the total monthly payment for the property. And then there's going to be a certain amount of months of that payment that are going to be required based on the loan program. So many times a jumbo loan will require 6 months. You get into the bigger loan amounts, they might want 12 to 18 months. So it really just depends. But if your monthly payment is $3,000 and you need 6 months of reserves, that is 6 times 3. And there you go. You need $18,000 in reserves. So, FHA does not require any kind of reserves at all. All right, we're on to conventional. Wendy says, makes sense. Thank you. And Wendy, you are very welcome. And again, you guys, this is interactive. I want you asking your questions. You're not bothering me. You're making this a better presentation. We're getting everybody the information that we need, and we're all getting educated along the way. So please keep them coming. More than happy to keep reading them and answering them for you. So conventional conforming, this is what we're going to talk to. So far, Priscilla got her answer on FHA. Now we're going to talk about conventional, Priscilla. So on a conventional loan, there are loan programs that have down payments as low as 3%. I can tell you that on a conventional loan with 3% down, the mortgage insurance and the interest rate are quite a bit higher, many times moving us into let's review that FHA scenario. But the bottom line is that 3% down on a conventional loan is a possibility. When might you want to do that? Well, maybe you're looking for a condominium and the condominium complex is not FHA approved. Well, a conventional loan does not need to have the complex approved in order to do the financing in that complex. So you may choose to go with a conventional loan, even though your mortgage insurance and your interest rate would be higher than what it could be if you went FHA. Now, I do want you guys to know that we do have ways of getting FHA condos approved. So that is something that we would want to talk about and consider prior to just taking a higher monthly payment because you went conventional. There are ways that we could look at an FHA loan even if the complex is not approved. So definitely make sure you're asking those questions. But technically, conventional loans you can get in with as little as 3% down. You start to see a really nice drop in mortgage insurance and interest rates when we get to 5% down and more. There are no mortgage insurance options available, and mortgage insurance can be removed later. So what does that mean? So as I had mentioned earlier in the show, mortgage insurance exists if you have less than 20% down payment in some way, shape, or form. Whether we give you a higher interest rate, and now there is no monthly mortgage insurance, whether you pay money up front to buy out the mortgage insurance, whether you put all of the money to buy it out up front and finance it, no matter what, there is going to be some sort of mortgage insurance if you are putting less than 10% down on a conventional loan. It's just a matter of how do we structure it. How we structure it is based on you, credit score, property type, debt to income ratio. What are the quotes we're getting from the mortgage insurance companies? And where do we cash flow the best? And that is something that we will take you personally through to determine what is best for your Scenario. Okay, so, and mortgage insurance, this is a nice thing over FHA. Mortgage insurance can be removed at a later date, where FHA, it cannot be. You would have to actually do a complete refinance of the loan, pay off the FHA loan to get out of the mortgage insurance. Where conventional, let's say you get into your mortgage today, interest rates are, 5.5%. And in 4 or 5 years from now, you've got the equity that you need. You've paid your mortgage balance down. You want to get rid of the mortgage insurance, but interest rates are 7.5 or 8%. You don't want to refinance. You don't want to get rid of your interest rate that you locked in on a 30-year fixed. That is where a conventional loan would be beneficial over an FHA, because you can call the mortgage lender and you can get the mortgage insurance removed as long as you have at least 22% in equity, or your LTV is at 78% or greater. And we all know what LTV means. So that is why sometimes we talk in these algorithms or acronyms or whatever you want to call them. So just keep that in mind. That is something that you can do with conventional that you cannot do with FHA. Mortgage insurance premiums can be more competitive than FHA. Well, does that make sense when I just said that FHA could have lower premiums? So again, like I mentioned with the FHA, if your credit score is about 680 or under, you will probably end up with a better mortgage insurance premium utilizing FHA if you are doing a minimum down payment. If you have a 10% down payment and your credit score is a 680, conventional might be less expensive than FHA. But if you have a 650 credit score and you're putting 3 or 5% down, FHA is definitely your lower rate and your lower mortgage insurance premium. But if you have a 700 or a 710 or 730 or 750 credit score, even with your minimum 5% down, conventional will give you a better mortgage insurance premium. So we're just going to look at it. We're going to look at you and we're going to look at your scenario and we're going to figure out what works best for you individually. Mortgage is a very individual job. I have to talk to you. You have to actually work with me. I have to know about you so that I can help to show you your options that ultimately don't come down to my choice. They come down to yours. But you need to be able to have all of the information to weigh out what is your best choice? What do you feel works best for you and your family? So let me check questions. No more questions right now. Let's keep on going. So I have on here, can be closed as a combined first and second mortgage. And this is absolutely true. Let's say that you have 10% money down, you have 15% money down. Maybe you're in Seattle, maybe you're in Los Angeles, you're trying to get to that $1 million price range. Your loan limits just aren't going to quite get you there. This might be an opportunity where we do your first mortgage at the loan limit to keep it conventional, and then we give you an equity line of credit or an equity loan, a fixed rate. Basically, it is both considered a second. They are liens against your property in second position. We give you that additional financing to make up the difference that you're short in down payment to help you get into the property that you're looking for. This would be very easily explained if, let's say, and I'm just going to go with round numbers and none of these are accurate. So please just bear with me. I'm in the studio. I'm doing this in a way that makes sense. Let's say that loan limits are $500,000. You want to buy $700,000 and you have 5% down. 7 times 5 is $35,000. So you have $35,000 on a $700,000 property, but the loan limit is $500,000. We're going to give you a $500,000 loan amount, and we're going to give you a second of $165,000 to gap the difference of what you have available of your $35,000. So you will need to talk to us, call us, let us take you through what you're looking to do and to determine what the very best options are for you. All right, the state of California, and it shouldn't even say this because I'm pretty sure that this is just about all 50 states at this point. It might be a little bit different. So again, I'm just quoting state of California because I'm sitting here, but I can tell you that it is no different in Washington, Arizona, all of the 13 states that I am personally licensed in. This does not change. So Tennessee, Georgia, Florida, Texas, Illinois, Idaho, North Carolina, Washington, Oregon, California, Nevada, I don't know what I've
Tennessee,
missed.
Florida, Texas, Illinois,
I don't know.
Missouri.
We got a lot of them. Missouri, that's right.
Colorado,
Yes. So we've got a lot of them. In all of these states that I've mentioned so far, if you have a minimum of 10% money down payment, it is your choice as to whether or not you want to have your monthly payment impounded. Impounded is that impound escrow account, right? So you can choose, if you have at least 10% down and you are doing a conventional loan, you can choose to make those payments on your own rather than bulking them in to one entire payment. So who is that good for? If you get a big bonus quarterly, or you get a bonus once a year, or you get commissions, and sometimes your commissions fluctuate, and one month you got a huge commission and the next month you got nothing, and you've got to make that last for 2 or 3 months. You might be a good candidate for somebody that wants just the principal and interest payment. You want to keep the monthly payment low every single month, and then you want to make your payments for your taxes when they come due and for your homeowner's insurance when it comes due. So we will talk about that. We can, you can decide what works best for you, but know that you cannot do that on an FHA loan. You cannot do that on a VA loan. You cannot do that on a USDA loan. You cannot do that on a bank statement loan. You cannot do that on an investor loan. Conventional conforming and jumbo conventional loans are the only two that would be something that you can choose to do. All right. Again, loan amounts up to $970, $800. It depends on the county. One thing to know is that the majority, I believe almost all of the United States, has a minimum loan amount of $647,200 throughout the U.S. for a conventional loan. If you are in a high cost area, that number will fluctuate. So here in LA, we've got $970, $800. In Seattle, it is not quite that high, but it is up there. I believe it is $770 and change in Boston. So every area, depending on the cost of living, just like FHA, will determine what the maximum loan size is for the area that you're looking in. So you guys just have to call us. There is no way for me to know off the top of my head what our minimum or our maximum loan size is for every single loan and every single product. So remember, I'm talking FHA, VA, conventional. I can't know them all in every single county in every single state. It's just not possible. But if you call me, I'll look it up. It takes me 3 minutes, and I'll let you know where you can go and what you can do. More lenient guidelines than jumbo. So not more lenient than FHA, trust me on that, but definitely more lenient than a jumbo mortgage. So again, you can go to a higher debt ratio. Most jumbo loans are going to want you to stay at about a 43% debt ratio. So if you have a 48% debt ratio or a 49.9, we can go to 50% on conventional. We might want to figure out how to do the loan conventional versus jumbo. Jumbo many times has a little bit better interest rate than a conventional loan. So if you do qualify with debt ratios and you've got the down payment required for jumbo and you've got the reserves required for jumbo, then we may want to go jumbo. But if you don't have the reserves, or you don't have the debt ratio, or you don't have the credit score, then we might want to try to figure out how to get you boxed into conventional versus that jumbo program. All right. Here we go. We're going on to jumbo. So again, nobody actually asked me any questions about conventional, but if something I said didn't make sense or you have any questions whatsoever, please put those into the feed. This is interactive and we're working through it as we go today.
I love the elephant.
Isn't the elephant great? I know.
He's
I love
my
him.
favorite. Every time this slide comes up, I love him.
Yes, I absolutely love it. So jumbo, what is a jumbo loan? So a jumbo loan, again, it's going to depend on your county and your state and what your maximum loan amount is that is allowed for where you're buying. So for example, Las Vegas, Nevada, your maximum loan amount for a conventional loan is $647,200. So if you want to buy that house for $800,000 and you want to put 10% down, which is a $720 loan amount, you are in a jumbo loan. You are not in a conventional loan. It is not possible. However, if you are the same person buying $800,000 and you're buying in Los Angeles or you're buying in San Diego, you are still a conventional loan because we have the higher loan limits because we are a higher cost area. So we need to figure out where you're buying and how much you're buying, and does jumbo, or do you need jumbo? Does jumbo make sense for you? Jumbo has some great product. You may not necessarily be over 647,200 in your area, or you might not actually be a jumbo loan for your area, but maybe you want an interest-only program. That is something that you can only get by going with a jumbo lender. Lender-specific guidelines. So you cannot call me right now and ask me, well, will jumbo allow? ? Every single jumbo lender is a private investor. So you guys have to think about that. And I know it doesn't seem private, but the bank Wells Fargo is private. The bank Bank of America is private. The bank Chase is private. The bank Citibank is private. All of these investors, they are investors. They hold their own money and they hold their own portfolio and they write their own guidelines. So every single bank will have a different guideline, will have different rules and restrictions around the loan. What's cool about working with Mortgage Mom Radio is that we work with all of them. So when you call us, I might be able to say, well, you know, you're not going to really work out for Chase because they want, this amount in reserves, but you would work out with Citi because you only need this for their reserve requirement. We're going to put you with the lender that's going to work best for you. So don't let the word jumbo scare you. If you don't have a 43% debt ratio, if you don't have a super high credit score, or you've got, you don't have the reserves required, call us and let's talk about which loan program that you may right now qualify for, or which loan program are you the closest to qualifying to, so that you've got a plan. Okay, I know I need to save 3 more months. Okay, I know I need to get my credit score up 10 more points. Okay, I know I need to pay this debt off to get to this debt ratio. We can take you through that to determine which program, which lender, and which bank is going to be the best one for you to go through. And that's what we do here. So please reach out and talk to us. We do this for a living, guys. This is what we do and we love it. And this is actually what pays the bills. And we hope that, by doing these educational courses and you being able to sit through this with us and learning things that you never knew before, that it makes you feel like you can call us and you can ask us questions and you can let us help guide you. So that's why we do these things. All right. On to a USDA loan, and USDA is amazing. I love USDA. There's a lot of areas around Priscilla in San Antonio, Texas, where you could do a USDA loan. There's, believe it or not, quite a bit of USDA in the outskirts of Los Angeles, San Bernardino, Riverside counties, Ventura, Santa Paula, lots of actually California, believe it or not, tons of areas in Washington, Nevada. USDA, you guys, is super awesome. And I can see you've got something you want to throw in.
Yeah, I was going to say Washington. People be surprised. I have a client looking up there now, and we're looking at USDA, and like on the outskirts of main cities. I was really surprised.
Yes, tons. Yeah. Georgia, Tennessee, Texas. Yeah, I said Texas to begin with, but Illinois. I mean, USDA loans are fantastic. There are some things around them that we do need to talk to you to make sure that you would qualify for, but the best part about the USDA loan is 100% financing. 100% financing. That means no down payment. Now, there are closing costs. All loans have closing costs. And we're going to get through that a little bit later in the PowerPoint. We're going to talk about closing costs. So do remember that you might need to ask a seller to cover the cost of the closing fees if you don't have anything saved. Or you might have to have, somewhere between 1.5% and 2%. If you want to buy a house for $500,000, you should probably try to get to about $8,000 to $10,000 in the bank to cover your closing costs. Or like I said, ask a seller to cover them. That would get you into a home in a rural area with zero down, out of pocket, moving into a house that you own. So USDA is a fabulous product. It truly is. We've just got to make sure that we qualify you for it. So how do we qualify you for it? So they have actually very generous income limits, very different than down payment assistance programs. They let you go to a much higher income amount that you earn and still qualify for that program. That income amount that you can earn does go up based on the amount of people that will be living in the home. So if you are going to move in, it's you and your spouse and your 3 kids, that's 5. Your mom's going to move in 2, that's 6. You now have a household of 6 people. The income that you're allowed to earn for a household of 6 people is quite a bit higher than a household for one. So we really want to talk to you about who will be living in your home, what income is coming in from your home, who is earning income in your home, to determine if you qualify for USDA. USDA actually has a super cool website. You guys can Google it and check it out. You can go to the USDA website. You can actually put Google USDA property or USDA, let's see, what do I usually, USDA qualifying, you'll find it. Trust me. It's pretty simple. You can put in a property address and it will show you if it is qualified for USDA. You can plug in your information, how many people are in your home, how much income is earned in your home, and it will tell you if you qualify for the USDA program or not. And then honestly, the very easiest thing to do is to just call us and let us walk you through that and do it for you. And it takes us like 3 minutes. Reduced monthly mortgage insurance. So USDA does have cheaper mortgage insurance by far than a FHA loan. It is usually lower than a conventional loan. So it is actually very beneficial in that way. Financing your closing costs. So this is cool. USDA will let you finance your closing costs. So then why did I tell you had to come up with money or you had to ask a seller? The only way that you can finance the closing costs with a USDA loan is if your appraisal comes in higher than the negotiated contract price. So if you negotiate your price at $300 and the contract comes in at $305, they will allow you to finance that additional $5,000. So there's no way for us to know in advance when you are negotiating on a property if our appraisal at a later date is going to come in at a higher value than the negotiated contract price. So we can't get you to count on that, which means that you want to either try to save up for it or you want to try to see if you can get the cost paid by the seller. And then obviously if your value comes in higher, then awesome. We can look at going that direction as well. So Heidi asks, how do I know if the house is considered qualified for USDA? So again, there is an actual lookup tool. That was the word I was looking for earlier when I was stumbling on my words. If you guys Google USDA lookup tool, property qualification, it will come up. It will take you to a website where you can put in the address and it will tell you if it is USDA capable. So that is the best way to look that up, Heidi. All right. So that is about it with USDA. And USDA is a fabulous program. I absolutely love it. It does have a lower debt ratio. You guys do need to know that. The debt ratios are lower than what a typical conventional would allow. So you do have to have a good amount of room in your qualifying ratio. But your credit score does not need to be fantastic. It can be very similar, to it's going to be a little bit lower, 620, 630, 640 is going to be okay. So USDA loans are truly, truly amazing and probably the best loan program for a first-time buyer. It does have to be your owner-occupied property, but very best program outside, I would say, of a VA loan, which you can only get if you're a vet. So keep that in mind. With that said, you guys can see that on my screen, I've got bank statement, self-employed borrowers. We're going to take a quick 10-second one. I just needed a sip of water. And when we get back, we're going to jump into bank statements, self-employed borrowers. How does that work? During that time, while we run this one, again, I want to make sure that I'm hitting the people that are on right now watching and listening to the workshop. If you are self-employed, and I don't care if it's even just one of you, but if one person out there is self-employed, please go ahead and put that into the comment section right now. Self-employed and bank statement products are really awesome, but they are only for self-employed borrowers. So if I have nobody on here that is self-employed, I don't want to take the time that it needs for you guys to sit here and listen to a program that doesn't make sense for you. So while we're at the commercial break, if anybody out there that's listening right now wants to know about self-employed, that's all you've got to write into the feed, self-employed, yes. And when we come back, we'll get to this bank statement program. So stay tuned. All right, so welcome back to Mortgage Mom Radio. This is our Homebuyer Workshop 2022. So far, we have made it through quite a few items. We've talked about FHA. We have talked about conventional. We've talked about the homeownership benefits and responsibilities. We've gone through buzzwords. And right before this last break, I actually said if there's anybody out there that is watching who is self-employed that wants to understand the bank statement program, to put that into the feed, and nobody answered it. So I am going to go ahead and click away, and we are going to skip that piece. If you are self-employed and you would like to know about the bank statement program, which is an alternative doc situation, we would not actually be using tax returns to qualify you, but instead your bank statements, please feel free to reach out to us directly. We'd be happy to take you through the program, the options, and how it works, and see if it is a right fit for you. So we are going to move on now to closing costs. Closing costs are very important, as I was talking about during the USDA piece. You usually need to have about 1.5% to 2% of your sales price is what closing costs can run you. Depending on where you're buying, closing costs change. It's based on your city. If there's city transfer taxes, county transfer taxes, if you're in Texas and you need to get a survey and you're paying for the survey, not the seller, whatever it is that might be taking place where you're living and where you're buying can change your closing costs. So just keep that in mind. And that is why I give you kind of an estimate of like 1.5% to 2%. When you get into some of the more expensive areas, Texas, your closing costs could be 2.5%. So just keep that in mind. You're going to want to go through an itemized fee sheet or estimate with me or my team based on where you're planning to buy, so that you know that you are saving for the right amount of closing costs. But the biggest mistake that people can make with closing costs is not knowing about them, not understanding how much that they are, and not knowing that they need to deal with them. I have many people who think they'll call me. They've already been pre-approved by another loan officer at a different bank. They call me, they're in escrow, and they're shopping their rates. And they just want to know if my rate is better. They heard me on the radio. They just want to call. They want to see what I can do. And then I start to talk to them. Well, what are you buying? And what's the price? And okay, well, what kind of loan are you doing? How much are you putting down? Okay, great. So are you prepared? Do you know about closing costs? Well, I mean, I know what closing costs are, but I mean, like, I need like what, $5,000? No, you probably need a lot more than that. So it's surprising to me that they aren't prepared. They don't know what they are, and they don't know how much money that they need over and beyond the actual down payment requirement for the loan that they're getting. So that is the biggest mistake that you can make, is not understanding them, not knowing how much that you should anticipate for them. Because if you are short on money, if you've got your down payment saved, and you just don't have the next piece, which is the closing costs. We are in a buyer's market right now. Start negotiating, start asking the seller for a credit to cover those closing costs. It is more than fair if you get a real estate agent that tells you that it is not possible, that they can't do that this market doesn't work that way. They are the wrong real estate agent for you. You can absolutely negotiate closing costs right now. You can absolutely negotiate repair credits. You can keep your contingencies in your contracts. They are doing them, and they're doing them every day. And if your agent is telling you that they can't do any of that, it is time to move on. So just keep that in mind. Your closing cost estimate is this is an actual itemized fee worksheet, what you see in this PowerPoint piece. This is not what a loan estimate looks like. This is something that a loan officer would work off of when starting your pre-approval with you and working through your numbers with you to get you that plan, to get you prepared, to make sure that you know how much money that you need, and how much your monthly payment will be, and what are those closing costs, and who are they being paid to, and what are they for. It is very important for you to go through those steps and those pieces. This is what an itemized fee worksheet would look like, and this would actually usually be 2 pages long. This is something that you would get if you do a pre-approval with me or my team. This is something that we are going to bring you through, that we are going to customize to you based on where you're buying and the city that you're buying in, so that you have an understanding at the day one of your pre-approval letter being issued to you of what you need to be cognizant of. Now, if I show you something, or Heather or Carrie show you something that you can't afford, the money is too high, the payment is too high, this gives us our opportunity to figure out how can we restructure things. Can we get the seller to pay some of the closing costs? Can we get the seller to buy your interest rate down for the first year or two to help you get into the home and get acclimated before that payment would go up? There's many things that we can do, and there's very creative ways that we can go about it, but we need to go through these pieces. And if you're working with a company or a loan officer that is not taking you from start to finish through your pre-approval, talking through your income, talking through the down payment, talking through the closing costs with you, it is time to move on and start shopping for somebody else, because you will be so frustrated and you will be so angry by the time that you get ready to close the deal that buying a home was no longer exciting and it was no longer a happy process. So we want to make sure that that is something that you are getting through from the get-go. So I had Will jumps on, says congrats Wendy on winning the gift, the t-shirt. So that's awesome. Mom on the Go says, sorry to backtrack. Can a single family home community complex qualify for an FHA or only conventional? I know condo townhomes have to be FHA approved, but wondering about other types of communities. So if the property, condo, townhome, single family, doesn't matter what is considered, if it is detached, it is not attached by a single wall, garage, or breezeway, you do not have to have FHA approval to get an FHA loan. If it is a condo or a townhome and it is attached to another unit, and it is considered a condo on title, then yes, it will need to be FHA approved. But again, before you feel like that's not an option and you have to go conventional, there are ways for us to do what's called a spot approval, which only takes about an extra 10 days in the escrow process, allows you to get the FHA loan, and gets the seller a sold and closed property. So you may still be able to do an FHA loan even if the complex is not approved. So make sure that you do reach out and talk to us about that. Janice jumped on. She said, I have my own company as an LLC in Nevada and take a payroll and run my business as an S Corp in California. So Janice, you are considered self-employed if you own more than 25% or more of the LLC or the S Corp. So if you are a 10% owner of the S Corp or the LLC and you are paying yourself a pay stub, that is totally fine. You are an employed borrower with W-2s to provide. If you own more than 25% in any kind of business whatsoever, then you are considered self-employed. You would have to provide us with your tax returns, your business returns for the LLC and the S Corp, and your W-2s and pay stubs, and we will determine what your monthly income is based on the nets of everything happening. So we do understand that some people have tax returns. They've got one company that passes through to another company. Absolutely understandable. There is no income truly at this point in time that somebody could throw at me that I do not understand. Been doing it for as long as I have. And even if I get a quick glitch in my giddy up, or Heidi does, between me and Heidi, there is no income that can come past our desk that we're not going to understand. And even if you give us your W-2s and your pay stubs and do not tell us that you are self-employed, we will find it. They do different kinds of checks and balances, and data verifies that it will come up that you are an owner of a business while we are in the middle of escrow, and your loan approval that you just obtained and your contingency that you just removed is no longer valid, and you could be standing with your pants down around your ankles and your contingency's gone and your escrow deposit lost. Just be honest out the gates, talk to us, give us everything. It's the best that I can tell every single person out there to do, and let us determine where the income is. And if we need to go into a bank statement type product, then that is definitely a process that we can walk down that road. So I hope that helps, Janice. All right, so closing costs. I do have a closing cost estimate that I've prepared for FHA. I prepared one for conventional as well. I'm going to actually, I think, take you guys through the conventional closing cost estimate. I know that we have been on here already for quite some time. I don't know how many of you are starting to get a little bit of anxiety, so I don't want to keep you too long. If you want to go line by line by line through a closing cost worksheet, I would be absolutely happy to do that with you. We've got them prepared. Heather can do it with you. Heidi can do it with you. Carrie, Cindy, any of the girls on the team can take you through that closing cost worksheet to give you an understanding of what the closing costs are. But I am going to have Mikey go ahead and click on that conventional estimate link. So Mikey, my son, is the one that's running all of the sound and equipment today. He is going to open this up for me so that you guys can actually see this worksheet on your screen. Mikey, if you can actually make that just a little bit bigger, maybe go to like 125% or something. What I want you guys to be aware of, this is the most important piece of it all of the rest of the fees, all of the rest of the closing costs are things that are not handled by the loan officer. The mortgage company doing your loan has absolutely no control over the third party fees whatsoever. So I just want to make sure that you guys can see what we have control over so that you know what when you're shopping and you're comparing and you're trying to figure out which lender you should work with. I want you to see what we have control over, and this is every lender out there, so that you know what to be asking when comparing. So number one, it's going to be the actual interest rate, obviously. And then number two, it is going to be everything that is in the 800 field. So there's no way for you to make that bigger, huh, Mike? Okay, so it's not letting him make it bigger. If you guys want me to go through this with you or anybody else on the team, you guys can call us. But the 800 field on an estimate, on a loan estimate, on a closing disclosure, or on a fee worksheet, the 800 is what the lender is charging you to do your loan. You will see things like underwriting, processing, credit reports, flood certs, funding fees. You will see everything in the 800 field. So you want to be able to ask, what are your fees as a lender? And what is your interest rate? And at what cost? So how many points for that rate? And what are your lender fees? Every other fee on the worksheet, every other closing cost is a third party outside fee that gets dictated to us that we have to show you but have no control over. So keep in mind that it is very easy to manipulate these closing cost worksheets. It is very easy for somebody to show less months of collected escrow for taxes and insurance, lower appraisal fees, lower escrow fees, lower title fees, lower survey costs. It is very, very easy to manipulate an estimate for a loan officer to make you believe that they are cheaper than going with somebody else. It is our job and it is our responsibility to make sure that you understand what you are signing up for. We are estimating to the best of our ability what we expect to see the costs for title, for escrow, for notary, for your insurance. It is our job to do the very best estimate that we can possibly do to get you prepared up front, not to try to win your business by being sneaky. So again, if you want to try to shop rates, shop lenders, figure out where you're getting your best deal, it's number one, what is your interest rate? Number two, what is that interest rate going to cost me? And number three, what are your lender's fees? That's it. 3 questions. That's what you need to know. So Mikey, go ahead and go back to the PowerPoint. I'm sorry if you guys couldn't actually see the way that this worksheet looked. I'm not sure how big that it actually looks for you on your end of YouTube, but we would be more than happy to take you through an estimate and teach you all about it if you want to get that personal one-on-one. All you have to do is go to our website, mortgagemomradio.com, and click on that appointment button. Schedule yourself an appointment for a consultation. It's 1 hour. It's free. You can call the office and book that consultation. However, it's easiest for you to get through to us. If you've got your handy dandy phone app to play the games, that would have given you the opportunity to contact us, send me an email, make an appointment. But do what you got to do to get through to us and make sure that you're talking with someone from the team to take you through that. So here we are. Where do you start? Okay. So you're thinking, okay, I'm understanding this. I've got my buzzwords. I know what loan program I want. I'm probably going to want to go USDA, and I'm going to go buy out in the middle of nowhere because I can work from town and I don't have to drive to work anymore. And everything I do is online. I'm doing my Homebuyer Workshop online. This is cool. I don't have to go anywhere. So if you feel like you're at a point where you are ready, you're ready to do an application. You want to get pre-approved. You want to start looking at homes. You want to be serious. You want to make an offer. You want to close on your home and get your keys. How do you get started? Where do you start? So the first thing is to understand that pre-qualified versus pre-approved are two totally different things. One is a loan officer's opinion. The second is an underwriter's opinion, who is ultimately the person that is going to make the decision, yes or no, if you're going to get the keys to that house. So you definitely want to work with a lending team that is going to get you pre-approved, not just pre-qualified. So you want to ask that question when you are calling other lenders. Are you submitting my file? Will an underwriter review my income? How do I know that this is a pre-approval versus a pre-qualification? Very, very important piece of the puzzle. Okay, so that is important. So we have what's called a Mortgage Mom Radio EMD guarantee. This is kind of part of the pre-approval process. If you are working with my team, this is definitely something that we can take you through. It is a really cool, super cool product. I know you guys are loving my emoji that's on there.
I'm laughing at the wrinkles.
I know, right?
The last show.
Yeah, and I need to make the hair longer now because my hair was short like that for years and years and years. So I need to make the hair longer. But the EMD insurance, what is that? So EMD is your earnest money deposit. When you write a contract and you present an offer to the seller and you say, hey, Mr. Seller, I'm willing to give you $200,000 to buy your home. And Mr. Seller comes back and says, awesome, accept, I'll take your offer. You have in your contract what is called your earnest money deposit. That is what is going to go into escrow or to title when you actually get the offer accepted. You are showing the seller your earnest to close. I am going to close on your home as long as everything pans out. I get my loan approval. Hey, contingency we talked about. The property checks out with my physical inspection. Hey, contingency we talked about. The appraisal comes in at value. Hey, contingency that we talked about. As long as all these things come in at value, I am closing on your home. So as my earnest to you, I'm going to put $5,000 into escrow. So you're going to deposit your money. We have a program where we will guarantee your $5,000 so that you do not lose that money should something happen. You don't get loan approval, something just doesn't happen right, we will guarantee it. If you want to know more about it, it is an amazing program. It is really cool. It definitely puts you at ease as the buyer, puts the seller at ease because they know if something goes wrong, they can keep your money because you're keeping my money. So nobody loses anything. It's a solid program. It helps your real estate agents. It helps the seller. It helps you as the buyer. If you want to know more, give us a call. We'll take you through what it is, and how it works. So, we also have a lock and shop program. So at the time that you are getting pre-approved, and again, you do not want to lock in a rate so that you can go out and start shopping for a house, because locking in a rate up front costs money. Unless you know that you are pre-approved and that you are going to buy a house and that you are seriously on the hunt to go find another, make an offer. If you are just kind of getting your feet wet and not sure and you're window shopping right now, lock and shop programs are not for you. But we do have lock and shop programs, which is great because you can lock in an interest rate today and you can go up to 150 days out before you would need to be closed to get that same rate. So with the way that interest rates have been going up here in the recent
few months.
Recent few months. You really well may be benefited by locking something in today, because today's rate, based on the way that things have been going, seem that in 100 and 20 days, in 90 days, 150 days, interest rates will be higher. So this is a super awesome product as well, something that we can also offer to you and talk about and what does it cost. But again, we want to get you pre-approved before you'd ever decide to do something like that. Okay, and I just keep checking my comments, make sure I'm not missing anything. So you guys are still hanging in there with me. I appreciate it so much. So for a pre-approval, you're ready. You want to do the pre-approval. What is it that we need from you? So on the screen, I've got just a couple of bullet points. A wage earner is somebody that's getting a W-2. Self-employed is obviously somebody that owns their own business, whether they're incorporated or they are not, whether they're filing a Schedule C and they're a sole proprietor, or whether they're an LLC or an S Corp, like our dear Janice that's on with us today. Self-employed, you guys are going to need different items than a wage earner would need, okay? So a wage earner, we're going to need 1 month of pay stubs. We're going to need 2 years of W-2s, and that might be it. Now, if you work overtime, if you get bonuses, if you get commissions, if your company gives you a car allowance, if you have some sort of variable pay that is taking place throughout the year, if you are hourly and sometimes you work 30 and sometimes you work 40, then we are going to want to get the final pay stub that you received within the year. So for example, we finished 2021. If your last pay stub in the year of 21 was December 2nd, December 5th, December 19th, December 24th, I don't care what the date was, but it had to have been paid to you, money sent to your bank account in the year. I want that last final pay stub for the most recent 2 years. So I would be asking you today to provide me with 2020 and 2021. Why do I want those final pay stubs? Well, rather than ordering a verification of employment from your employer and having to wait for their HR department to get that back to me, I can immediately jump in and run numbers if you provide this to me. Most, I would say about 90% of pay stubs have a breakdown on the pay stubs with a running year-to-date total. So if you gave me the final year end for 21 and for 20 and you worked overtime, I should be able to see how much your total overtime for the entire year of 2020 or 2021 was that you earned. I should be able to see where your total hourly was. I should be able to see if you had any bonuses, any commissions, any other pay, right? So we want those final pay stubs to be able to do the averages on the OT and on the bonus and on the commissions. Very, very important. Self-employed borrowers, hey guys, we definitely need to get your most recent 2 years tax returns. We do have some programs that will let us use 1 year of tax returns. So that comes in nice if you were a, maybe just had a really bad 2020, because let's face it, a lot of people had a bad 2020 and 2021 was, back at things and much, much better. So maybe we want to get you qualified just off of 21. That product does exist, but you want to start off by providing us with the 2 months. We will then talk to you about, after analyzing the numbers, hey, it looks like you're going to fit best into this scenario, which means that this is the loan program that we want to use, which means that this is how much money that we need in down payment, etc. So for you self-employed borrowers, make sure that you guys are getting us your tax returns for at least 2 years. If you are an LLC or an S Corp or a C Corp and you own more than 25% of the business, I will need to get the business returns for 2 years as well. And you also need to provide me with those K1s that would come along with an S Corp or an LLC if they exist. If you're 100% owner of your LLC, you're actually filing a Schedule C on your personal return. If you're 100% owner of your K1, then obviously it's going to show me that inside of the tax return. So we're going to look and see what we've got, but this gives you an idea of what we need, and you definitely need to be able to provide us with a profit and loss statement. Now, some people don't know what a profit and loss is. They don't even know how to create one. We've been doing it for a long time, and we'd be more than happy to walk you through that and help you to create it. It is not difficult whatsoever. It's as simple as a Word document or an Excel spreadsheet. We can walk you through your tax return, show you where to get your numbers from for your P&L, and then obviously you'll just be showing us numbers from this year instead of what went on the tax return from last year. But it is very simple, and we can definitely help you to figure that out. Now, all borrowers, self-employed or wage earners, you guys are going to need to give us a copy of your driver's license. If it is expired, you need to get me a new one. And you guys need to make sure if you go and you get it updated that you have the actual physical picture by the time you are signing your loan documents, or a notary is not going to notarize the documents. So make sure you guys, if you're thinking about buying a home, you know it expires on your birthday. That's next month. You might want to go take care of that now so that you are not expired at the time that we're trying to get your deal closed. A retirement account, if you are thinking about using your 401k or a 203b or some other, an IRA, some sort of an account that is retirement, may not necessarily give you full access to the funds at this point in time. We will need what's called the terms and conditions of withdrawal. That is going to show us what you are allowed and when you are allowed to take the funds. That tells us that you can take X amount of dollars from your 401k to buy your primary residence, blah, 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 blah. If you don't know what the terms and conditions of withdrawal are, it's very easy to call the 401k company or go to their website and they will be able to provide those to you. If you own any other property, and this is my favorite one, I don't own another house, okay? But you have a mortgage on your credit report. Where is that coming? Oh, I thought I was just a co-signer. I co-signed for my sister last year. Okay, you own a house. So if you have any other real estate of any kind, even if you don't think you own it, but you think you co-signed on it, or you co-signed on it and you don't think you own it, whatever that the situation might be, I need a copy of the mortgage statement, I need a copy of the property taxes, and I need a copy of the homeowner's insurance. From there, we're going to figure out, do we need to hit you for that debt? Do we not need to hit you for the debt? Oh, cool. Your sister's owned it for 2 years. She makes all of the payments. She makes it direct to the bank. It comes out of her bank account. Coolio, get me a 12-month history of your sister's payments to the credit, to the mortgage company, and we're going to remove that debt from your qualifying ratio. So just keep in mind, if you own a property, land, a lot of people buy land and they think, well, I don't have a payment. I paid cash. I don't have any insurance. It's cash. Okay, but you do have property taxes. So if you own any kind of real property, REAL, real property, we need to make sure you guys provide us with anything that you do have, even if it is just a tax bill for a piece of land. Okay, here we go. Contest number 3. So we want you guys to follow us on TikTok. I know that you guys are watching this right now. You're learning. We're giving you all kinds of advice. You guys listen to the show on radio. Maybe you tune in on YouTube once a week, or maybe you listen by podcast. TikTok is cool because we're actually taking shows that I've done and we're grabbing like 35-second to 2-minute clips, and we're throwing it up on TikTok. So it keeps you in the know, learning, educating, all kinds of new stuff. We're doing this like every other couple of days. So you're getting lots of pieces there. We would love it if you guys would follow us on TikTok. So the first person that I get that pops up that says that I have a new follower on TikTok, you guys are going to get to pick out a t-shirt. So if you are a TikTok listener, watcher, go there right now and find mortgage_mom_radio. So remember, there's a lot of people trying to call themselves the mortgage mom. I'm the only one that's actually trademarked that. It is mine. It is me. I am the only one that is legally allowed to do it. But in order to differentiate myself, I always use radio. So it is mortgage_mom_radio. That is how you find us on TikTok. When I see my first new follower on TikTok, I will make sure that I make an announcement. So with that, guys, we're going to go ahead. And this is where we're going to bring Heather into the show. I am going to get to step away. It's going to be my turn to drink every time she says the word scenario.
I think it should be realtor.
Realtor, every time you say the word
every
realtor?
time I say the word
okay.
realtor.
All right, I'm willing to do it.
It's going to happen a lot.
This was supposed to be a wine and cheese show, and you guys were supposed to come in person and enjoy it with us in a relaxing afternoon. And unfortunately, we had a couple of people in the office that did get sick, and we just didn't feel that it was right to put you guys in harm's way of the possibility of me or Heather possibly having it right now and, not being positive yet. So that's why we are only virtual for this show. But since we were supposed to be wine and cheese in it, I have no problem grabbing one of those margaritas and playing a game along. So
get on it.
Yes,
I will tell you.
She's going to move. I'm going to move. She's going to come over.
Yeah, we're going to move. So,
yeah.
So every time I say realtor.
Yes. Yes, I love it. So Heather's going to go ahead and come on over here. While we do that, Mikey's going to run just a super quick commercial to just give us a minute to transfer seats here on the couch. And then she's going to get into, you've been pre-approved, you understand what you're doing, and you're ready to get out there and start looking for homes. How do you select the right realtor? And this is
What
a
word was
very
that?
important piece. Realtor. All right, so 10 seconds. Stay tuned. We'll be right back.
All right, hi guys, it's me now with you, and Debbie's gonna drink every time we say realtor here. So,
I'm prepared.
you better be. Oh, look, not just another realtor. Amen. Who cares? I love it. So choosing a realtor is one of the most important things that you can do when it comes to buying a home. And we were talking a little bit earlier, there's a difference between real estate agent and realtor. A realtor is actually somebody who is a member of the National Association of Realtors, or NAR, and also more specifically of your state. Here in California, it's the California Association of Realtors, or CAR.
I am not, realtors not can't be the word, because I am not going to be able to drive home.
Uber.
It's not going to happen.
Okay, how about pick another word then?
Uh,
I don't know.
mm,
You think about it. Buying,
Buyer.
selling, buyer. That's a great one.
Okay.
So, see, she gave up already. So one of the things that we want to talk about is, why is it, important? Why is there a distinction? Well, somebody who's considered a real estate agent is somebody who's just holding a real estate license. They are not a member of the National Association of Realtors. They're not a member of the board, most likely. So you want to make sure that that person is acting, in your best interest. Somebody who's licensed by, who is a licensed realtor and is also a part of NAR and their local board, has a bunch of ethic codes they have to abide by. They have to be, honest and faithful and truthful when they're dealing with you. So you really want to make sure that you look for somebody who has that realtor designation against their name. So that's super important there. I think I'm going to get this right here. Okay. I did. So when you're selecting your realtor, you need to know a couple different things. The most important thing is that realtor is vested in you as a buyer. A lot of realtors, are really worried about getting the home closed, which is important, but also they need to be able to hear what you're asking for as far as, what you're looking for in a home. You as the client, buyer, you want to make sure that you explain to them, what is it that you're looking for? Do you want a 4-bedroom home and they're only showing you 3 bedrooms? You need to make it perfectly clear to them, look, we really need a 4th bedroom because I work from home, my significant other works from home, we have an in-law that stays with us, or we just want to have a 4th bedroom. Whatever is important to you, you need to make sure that you're conveying that to them and that they're listening to you. Sometimes in certain markets, your specific wants and needs aren't available, and that time the realtor should say to you, I'm really trying to accommodate this. Unfortunately, right now, we don't have anything like that available. This is what we do have. And that's where you're going to work with them to get what you need and to have what you want as far as your interest goes, and that they're looking for you to find you that perfect home. So, what do you need? Do you need a 3-bedroom? Do you need a 4-bedroom? You really need to be open with them and tell them so they're showing you the right properties. Don't tell them, oh, a 2-bedroom's okay, yeah, I'll look at it, if you really need that 3rd bedroom. It's a waste of your time, and we really don't want to waste your time, whether we're showing you houses that work or don't work, something like that. And that goes into, what is it that you want as well? Do you want a pool? Do you need a pool? What are your wants? So you're going to kind of have, what do you need and what do you want? And you're going to want to blend those together with what you can afford and find that home for you. The most important thing, and Debbie kind of touched on this a little bit ago, is we're kind of transitioning right now from a seller's market where the seller was really in, I call it the catbird seat, and they were really getting everything that they wanted. They were getting their price, they were having multiple offers, sometimes 30, 50. I saw some houses with 100 offers on them in the first weekend. They were getting everything they wanted. Appraisals waived, home inspections waived. Basically, buyers were going out and giving them everything that they needed, okay, or that they wanted. Exactly, buyers. And the seller was really getting exactly what they wanted from that buyer, and the buyer really didn't have any leverage in the transaction. So now, since rates have kind of gone up a little bit, they're still not bad by any means. We're starting to see a little bit of a transition into what we call a buyer's market. And so we're at that cusp right now, and you're starting to see it because home prices are starting to come down. Maybe you look on Zillow or Redfin and you're noticing, price reduced 10,000, price reduced 5,000. That starts to indicate that we're maybe going into, a buyer's market. When that happens, you as a buyer have now become in the catbird seat, which means you're there and you can negotiate. So then we need to talk with your realtor and say, okay, buyer needs X amount of closing costs paid. Maybe you're right there on the cusp of buying that home and you have your down payment and you almost have all of your closing costs saved. Maybe you don't have as much closing costs saved as you thought you did, and you need a little help from the seller. That's where we're going to talk with your agent and say, look, the buyer really needs to have $5,000 paid or maybe $10,000 paid, depending on where you're buying, and you can ask the seller for that. Coming into a buyer's market, sellers are more inclined to work with you on those closing costs. Rather than reducing their prices by $10,000, we think it's more advantageous for them to give you like $10,000 in closing costs. If you have more questions on that, give us a call. We're happy to explain how that works. If your realtor says, I don't know what you're talking about, we don't ask sellers for closing costs. Yes, they do. They just haven't had to do it in a while. Give us a call, have your agent call us. We're more than happy to work with them and explain to them the process. Okay. You also want to make sure that your realtor stays within your budget. You don't want to be out looking at $600,000 properties if you only qualify for, $550,000. You're $50,000 off. Those properties really aren't going to work for you. You need to make sure that they're keeping you in line with the price that you're approved for. Otherwise, you're not going to be able to write an offer and you're out looking at beautiful homes. You might fall in love with one that's amazing, but you don't qualify for it. So that's a little hard to do. Okay. Realtors are also experts in their field, okay? They should know the area. In some areas, we have a lot of the newer homes have what's called a Melrose, or now they're starting to call them a CCD fee, which is a community development fee. You really want your agent to know, are there any of these fees? Those fees will impact what your taxes are on your home. So for example, if you're here in Los Angeles County, our tax base is generally 1.25%. The Melrose can take it up another 0.5%, up to maybe 1.75 or even higher. Sometimes it's lower, it just depends. But that could affect how much you qualify for when you're looking at purchasing a home. So it's important that the realtor know, are there any Melrose fees, maybe a landscape maintenance fee, maybe a CCD fee, or also if there's a homeowners association fee. If you know that you are a contractor and you drive a big truck with all of your equipment on it, you need to know if there's a homeowners association, because sometimes they may not allow that type of truck to be parked in that area. So super important that your agent knows these things so that they can guide you on where to go.
Hey, we have a winner.
We do?
Janice, because it says J. Baudette. I hope I'm saying that right. So it looks like Janice.
Congratulations,
yes,
Janice.
she gets a t-shirt. Okay, sorry. Didn't mean to interrupt you, but it came
fine.
up.
You're good. So back to it. Debbie, I know mentioned, we were talking a little bit before about, the agent knowing whether or not the project is FHA or VA approved, kind of just to touch on that a little bit. You want to make sure as a buyer that you are, if you're working with an FHA loan or a VA loan, that you are looking in the proper complexes that is approved. Again, If the complex is not approved and you're an FHA buyer, we can do spot approvals. So don't let your agent deter you and say, oh, this complex is not FHA approved. You know, you're doing an FHA loan. We have to look somewhere else. That might not necessarily be the case. We may actually be able to get you that loan in there and get that complex spot approved or that unit spot approved. And it's relatively quick, less than 2 weeks to do. Most sellers nowadays would be willing to give you that extra week and a half, 2 weeks to get that done so that we can get you closed on your house. Another important thing right now, a lot of buyers, you know, that have children are concerned about school districts. If you have children and you want them to be in a specific school district, you want to make sure that your agent knows or can guide you where to go to find out the information for the different school districts. All right, I'm gonna let you tell me if we have questions.
There's none right now, but remember, you guys, it's interactive, and so if you have questions while she's going through this part, definitely ask them, because things have changed. I mean, Heather started off being extremely nice and saying, well, you know, things are, you know, seeming to start to shift. They've shifted. They've literally shifted. We are in a buyer's market right now.
Yes. It's actually, we've kind of passed that cusp of going downhill. And the roller coaster
is it
going
coming
down.
Oh no, it's here.
Yeah,
it's here.
Going down.
Yeah.
So as a buyer, you definitely have a lot more tools in your tool belt right now than you did 6 months ago. And so that's where, you know, we're talking about use those tools. Don't be afraid to look at the loans because the rates are higher. We did a scenario where we looked at what it would be like to buy a home now versus 6 months or a year from now based on different home prices and different rates. It was still better to buy a home now. It was about a savings of $100 for the client. So if you know that you're going to save money on that home and you can get some of your closing costs paid or help buy down your rate, absolutely take advantage of that. We will tell you how you can do that for sure. Okay, so you found your dream home and you're ready to make an offer. This form here is a general California Association of Realtors form. It's used all throughout the state of California. If you're in Washington, Nevada, Arizona, Texas, no matter where you're at, your state or your MLS area will definitely have a form that is generalized for everybody to use. You want to make sure your realtor is familiar with it, they can explain it to you, and you know what's on it. If you are not working with a realtor, they cannot use these forms. And you'll notice how it says up in the top on this one, it says California Association of Realtors. Down below that you can't see, there's a bunch of information about how it's trademarked and such. If you are working with a real estate agent, they will use more generic forms, maybe something they've made up, maybe something they found on the web. They cannot use these forms. I know the forms are all over the webs. Sometimes there's been debate on whether or not they're legal if it's used by a non-realtor. So you want to make sure that you're getting the forms that you want. This form is there to protect you as a buyer. It's also there to protect you as a seller. It's there to ask you questions to make sure that you're providing all the information you need, whether you are a buyer or whether you are a seller, to the other party. So you want to make sure that you get with that realtor, they know what this form is, and that they can help explain it to you, and that you're getting everything you need.
So I have a question for you, just
Absolutely.
because you have been a real estate agent for a long time.
Yeah.
And what I am wondering is, I know a lot of people would say, you know, oh, well, I don't want an HOA, or I do want an HOA, or I don't want to have to worry about, you know, taking care of, you know, the property, and I don't want to do landscape. And so I really want to be in a condo. One thing that we've never talked about in any of these presentations, so I thought it was kind of cool to approach, is, what if I have a big dog? Like my dog, she's a 150-pound dog.
Yeah, big newfie.
Right.
Yeah, there are a lot of associations, especially townhomes and condos, that will not allow dogs over 35 pounds. So if you have like a golden retriever or a Labrador, super sweet dogs, newfies, they might give you pushback on that. It's really important to know. Also, if you're, you know, looking at townhomes and condos, they might have something in there against, you know, certain breeds of dogs that may be categorized, you know, as, you know, not necessarily nice. We'll just say it that way. So you really aggressive. That's the word. Thank you. So you really need to know this, especially, you know, I grew up with pit bulls. I absolutely love them. But there are, you know, areas that they cannot be allowed in.
Stereotype.
They do. There's a bunch of them. So if you are an owner of a dog, even German Shepherds, I had a Dalmatian and I had issues with that. You really need to make sure that you're being aware in the HOAs that you're going in, because even though you get in, if somebody complains, it could be a problem for you. So it's important that the realtor knows that. Yes, this is an HOA. They don't have any problems with animals. Most of the time, we don't see it on single family residences that are members of HOAs, but you can see it more often in a condo, especially sometimes a townhome. It depends on where it's located. Good question.
Okay, and I have another HOA question.
She got a follow-up.
I do have a follow-up. So, you know, me and you were boaters. We love Lake Havasu.
Yes.
We love anything
Water. Yeah.
We like to go out to
Dirt
the
toys.
desert, right? That's just who we are. And
Yes.
so, you know, part of us getting prepared and ready for a trip is having to bring
the
everything
motor
home. Or, you know, like I know that you guys keep your boat at your house.
We do.
Where I can't do that.
Yes.
My HOA would not allow it. So just while everybody, since you're the resident real estate agent, I mean, honestly, you guys, if looking at Heather right now and understanding where she's at, if you have questions about real estate, now is the time.
Yeah.
You've got somebody that the majority of her career has been in real estate, and only
You
for
haven't
the
said 30 years yet. I'm waiting for it to come. the reality, what is it? The 30 years of her career.
right. I mean, you're probably close. I mean, it's probably
super
28.
close.
It's probably 28ish, maybe 29, something like that.
Yeah.
But the majority of those years were in real estate, where I'm backwards. The majority of my career has been in mortgage. Now we've both done both, right?
Absolutely.
But I want anybody out there listening to understand the reason that Heather is sitting in front of you right now doing this real estate part of the presentation is that this is her expertise. She has done it forever. She has gotten listings from banks for foreclosures, and she's done short sales, and she's done everything
Probates.
probates.
Everything you can think of. If you got a probate question, if you've got a trust sale question, if you've got a foreclosure question or a short sale, what is the difference? I'm here. I will happily answer all of it for you.
Right.
Absolutely.
So my question to you would be, is that obviously, you know, you keep your boat at home. You love having your boat at home.
Yes.
And you have no problem with that because you have no HOA.
No HOA.
Okay. So, and then I know that I've been in a couple of different HOAs, and they all have different rules, but what do you seem to be the most common as far as, okay, I have a motorhome, I have a boat, I want to bring it home. What do you kind of see as a common allowance for those things to happen when they don't necessarily allow you to keep it there on site?
So, and that's a great question, because if you have anything like that and you want to be able to, so for me, I have my motorhome and my boat at my house and our dirt toys. So generally a few days before we go out, sometimes up to a week, depending on my schedule, if I can only do things a little bit at night, we will pull the motorhome out in front of our house for a week or so before we go. If you are in an HOA, generally they will allow you 24 to 48 hours. Rarely do I see 72 hours, and you have to have approval. And I know you kind of ran into this before too.
Oh, I get ticketed all the time.
So if that is important to you, like if you are, oh my gosh, October through March, you know, we are out in the desert and we're at Glamis, or we're, you know, in Utah in the dunes, wherever you're at, and it's really important, you need to know that maybe an HOA might not work for you, because you're going to be restricted on when you can bring those, you know, motorhomes, toys, trailers, whatever, you know, enclosed fifth wheel, whatever it is that you have, and put it in front of your home. And if 2 days is not enough for you and you're like, oh my gosh, I need 4 or 5, perhaps an HOA is not right for you. Or you come home late Sunday night and you got to work on Monday, and the last thing you want to do is unload everything from the fifth wheel or the trailer or whatever. Then, you know, maybe you can't get it done by Tuesday. Maybe an HOA, you know, is not for you. I know that sometimes they will allow additional time. It's very rare and it's difficult because the homeowners complain. So that's kind of one thing you want to make sure of. Me, I don't have to worry about that, but I took that into consideration when I bought my home. So, you know, I bought a little bit smaller house because it had the RV and it had the abilities to park all of that in there. So again, it goes back to your realtor. You want to make sure that as a buyer, you're explaining to your realtor, this is what I do. This is important to me. Or my kids don't go to camp during the summer, so I need a pool to get their energy out. You know, whatever it is. Or I have, you know, my mother-in-law stays with me all the time, and I, you know, want a 2-story with a 1 bedroom downstairs so she can be down there and have her time to herself, but at the same time be in the same home with us and not have a hotel or something like that. Whatever it is, you have a home office and you homeschool your children and you need a loft or a separate bedroom to do that. You need to make sure that you're explaining that to your agent so that you get that in there.
So you got another question.
Okay.
Heidi asks, what happens if I am working with an agent and I decide that they are not really understanding what my needs are? Can I work with someone else or am I committed to that agent?
Great question. So depending on where you live, here in California, we have a form called a buyer broker agreement. I haven't seen one in a long time. They were pretty popular when they first came out. If you have a buyer broker agreement, you can cancel it. And what that is it's just like what it sounds like. You've signed an agreement with that realtor and with that broker, whomever they work with, that they're going to work on your behalf. They're going to represent you, find you your home, get you the best deal. So if you find that maybe they're not working, for you, or they're just not, maybe they're not even just, they're not doing anything for you. Or maybe they're working really hard, but it's just not what you need. You like them, they're great, it's just not working. You can cancel that agreement. You would want to reach out to them, let them know, hey, realtor, this isn't working for me. I don't want to buy now, or I still want to buy, but I just don't think we're clicking, whatever it is. Some people just don't ever call them again, which I don't think is right, because I really think that we all grow from knowing what's wrong. So I would reach out to that agent and say, you know what, look, I keep asking you for 4 bedrooms, but you're sending me 3 bedrooms, or my price range is 500 and you're sending me 600. I just think maybe we have different ideas of what I'm looking for, and I don't want to waste your time. So perhaps it'd be better if I worked with somebody else. You can always go work with somebody else. I would just be upfront. The one thing you don't want to do is work with 3 or 4 agents at a time, because then you're going to have 3 or 4 agents doing exactly the same thing for you. You're going to be inundated with phone calls. You're going to be inundated with the same properties. And some people think it works a little bit better. It really doesn't. They're all going to hopefully show you the same things. If you have that agent that you trust and that you are relying on, and they're doing what they're supposed to do for you, you shouldn't need to work with several.
Okay. And you got a comment that says it's from Northboundant, and it says, Ken Shay in the house.
What? Ken's a client. I love Ken. Speaking of clients and buying houses, Ken bought a house. So we did the loan last year, and he's actually looking at buying a house across the street. So I love it. So that's the thing, you got to make sure that, that the property works for you, and it might work at the time, like for Ken, and now something else came better and he's looking at maybe moving on up in the world. So you've got that too. Hey, Ken. So it's important, just make sure that you have that realtor, that that they're working for you, that they're using the proper forms that are going to protect you as a buyer, and also protect the sellers, in case you're out there, Ken looking to sell. His agent's amazing. I absolutely love her. So love working with her. But so this is the form. Let's see what else we got on here. Do you have another one?
I don't. That was honestly just kind of giving them an idea of what a contract looks like. It didn't have anything to do with you trying to explain it. Or
in California, they just revised them in December, and I think they're 16 pages now, which is crazy. So expect them to be long. Expect them to be redundant. They say the same thing. They really want to hit home. It's important to do an appraisal. It's important to do a home inspection. How much are you offering? How much are you putting down? Are you asking for closing costs? It deciphers all of that generally within the first 3 or 4 pages.
I actually really like the contract that we get, the contract that is used in Texas, and I really like the contract that is used in Vegas, because the those two, and we call it Vegas, it's Nevada, right? But I like that they have what's called an option, which is different. You don't have that here in California at all, and the option is basically like you've got X amount of time to just basically say,
I don't want the home.
I don't want it. Yeah, I'm out. Forget it. It doesn't work. Right. And so, and it's, I think that piece is kind of nice. So again, this wasn't about showing you guys a contract or going through a contract with you. It was just kind of giving you an idea that, this is what a contract looks like.
And every state is different. I think
every
Texas
state
has that too. Priscilla can.
Yeah, they do. They've got, that's what I was saying. Texas and Nevada have that option, and I like that option, but they're all a little bit different.
All a little bit different. So if you're looking in a different state and you have a question, feel free to reach out. We'll let you know. So we're going to go over a couple different, we went over terms a little while ago. These are more real.
Oh, he says, Ken says he was here to see Heather drink. Just kidding.
You missed it. You missed it, Ken. You're a little late. Now it's Debbie's turn. Every time I say buyer, but she's not keeping up.
I'm not.
So, we should put photos, backstage photos,
Right.
like on the website so
Yeah,
you can see.
exactly.
But anyway, so we have a couple of things going on here. We talked about different words and terminologies and acronyms. In the real estate section of it too, we actually have our own. So you might hear the words earnest money deposit. We don't ever say that. We say EMD. Your EMD is your deposit that you're giving to escrow within 2 to 3 days of the contract being completely executed, meaning signed by both buyer and seller. So if you have a contract with the seller, you've agreed, everybody's got everything in writing, you're going to open escrow, you are going to give your earnest money deposit or your EMD to escrow immediately. And a lot of people don't understand that that is immediately. So if you're purchasing a home, let's say at $500,000 and your realtor writes in there that you're going to give a 3% deposit, that's $15,000. You need to make sure that you have that readily available so you can wire it into escrow within 24 to 72 hours. Now, what is that deposit? So if you're telling me, Heather, I'm doing an FHA loan and my total down payment is only 3.5, yeah, you're exactly right. It's still 3.5%, but your earnest money is the money that you put into escrow to show the seller that you are serious about buying their home. They are taking their home off the market. They are not looking at any other offers except maybe backup offers, so that you can move forward on the home. And to do that, you're putting forth good faith with this money saying, I am serious and I do want to buy your home. Now, when we were talking earlier about contingencies like your home inspection and your appraisal, and we say you want your deposit back, that is the money that we are talking about, the money that you have into escrow for your down payment or for your deposit. Okay, so once you get through all of your contingencies, home inspection's fine, appraisal's fine, your loan contingency's great, and you're getting to close your home, that 3% that you put in at the beginning of escrow goes towards your down payment and your closing costs. So for example, if your total closing costs, I'm throwing out round numbers in the studio, don't have any on me by hand, but if your total closing costs are $30,000 and you've already got $15,000 in escrow, the remainder that you bring in is going to be $15,000, if that makes sense. Now, if for some reason the home inspection comes back and it needs a whole new roof or plumbing or air conditioning, whatever, or the appraisal doesn't come back at the value that you agreed to purchase it on, and you say, I'm going to cancel this contract, we can't come to an agreement, realtor, I need to just cancel. You are entitled to that full deposit back if you're within your contingency timeframes. And that's super important. You want to make sure that you know what your timeframes are, that your realtor's staying up with you on those timeframes, and that if you are to cancel, you're canceling within those timeframes to get your earnest money or your EMD back. Make sense?
Makes total sense.
Perfect.
Yes. Ken actually jumps in. He says, best broker lender in LA. Love you all. And then he says, buyer.
That's you.
I know.
You're drinking.
I know. I'm drinking. Thanks, Ken. Thanks, Ken. Appreciate it.
Ken. Ken is funny. He, I don't want to tell too much about him, but he's in the movie industry, TV industry. So he's a lot of fun.
Well, what I hope that people can hear from, the comments and things that, is that we really do get personally involved.
Absolutely.
With the people that we work
Yes.
with, that our clients become family, truly.
Yes,
and,
they do.
we end up knowing everything about you, what kind of dog you have, what color underwear you wear,
Yes.
what is your favorite drink,
Yes.
Are you a vodka guy or a Jim Beam
Ken's
guy?
a red wine guy. He'll check me on that one.
Right.
Yeah.
So, but it, it is really, really
Yeah.
important. The one thing that I can say about that is that creating the trust, creating, creating the relationship is the most important piece of the entire experience.
Yeah.
The interest rate could be different by, an eighth or a
nothing
quarter.
much.
And in either direction, right? I'm not saying them coming to us, it's going to be different. But what I'm saying is that when you work with somebody that you feel that bond and that connection with, and you have the communication, and just like the same with the real estate agent and sellers, please hear me out on this.
Yeah.
Even if you get somebody that's willing to do your listing for less money than someone else,
Yes.
the relationship, the bond, and getting it done, and the happiness and the less stress and everything that comes through because of that relationship
Right.
is not worth an eighth or a quarter better in rate, or a quarter better or a half better in the commission that you might pay. I mean, and that's just my
Well, when
my
you
opinion.
call 6 months later and you say, I got this tax bill and it says supplemental, and what is that? We answer, we call and we find out. Matter of fact, I've made calls with clients before to their lender saying this is incorrect, we need to fix this, and spent days doing it because I honestly have an amazing relationship with that person. They're my friend when it ends, and I want to make sure that they're taken care of long after we're closed. So that's super important to me. And, and whether it's Ken, he knows that. And Ken was actually referred from another client that we had that was working with a different lender, and the lender couldn't get it done. And Ken's friend came to me and said, Heather, I have 21 days to close this. Can you even do that? I did. We took the application and we got them closed on the day that they were supposed to close. And his friend was so like, this is amazing, referred Ken, and we worked with Ken for a while. So that's the whole thing, is I don't think people understand that we build the relationship with you. We don't want you to go away at the end, and I want you to be able to call us, and I want you to be able to ask us the questions that you have, because that's important to us. I want to have that relationship with you. I want to be able to make sure that you feel comfortable calling, and I want to be able to answer the questions.
Yeah, we are forever their lender.
Forever.
Mom on the Go says, how soon after you and the seller have agreed on a contract does the earnest money go into escrow? 1 day, more?
Usually more. So if you're working on a contract and it's the weekend, obviously escrow. It's generally the days from the last person signing. So if you have a buyer makes an offer and a seller counters it, let's say, it'll start escrow the day that the buyer executes that counter, says, yes, I accept this. The next day or that day, depending on if it's a work day, escrow will open. And from that, depending on what's specified in your contract, I believe in the California contracts, and I think a couple other states, it's generally 3 days to get your deposit in. And you'll want to work with escrow. A lot of times people will wire their funds in, but just as long as escrow knows that you're getting on it and you're not dropping the ball and not doing it, you're fine. Some people walk a personal check in. It really depends on the escrow and the state that you're in, but usually within a couple days.
Okay. And Ken says, truth, all jokes aside, this was my first home. This was not my first home. I had a house in Valencia and I own a place in Sacramento. I was working with another lender on this Northridge home and they were horrible. A friend, Susan Chris, recommended Mortgage Mom, and Heather and team were incredible, and I truly think of them as family. Ken, we think of you as family. Absolutely. As far as like I was trying to rack my brains out as to who could I get you hooked up with. So, new single dude out there, great guy. Anybody watching the show, if you guys are thinking about it, check out.
And he's amazing.
Check out Ken. But no, it is about the relationship. And Ken, thank you so much for all of that. It truly feels special to us that you would get in there and make those comments. So let's roll this piece up, because when we're done, we get to play Kahoot.
Oh, I'm excited. Oh, yes. They need to download the Kahoots.
They don't have to download it. So from a computer or a phone, they can literally just go Kahoot.it, Kahoot.it. Make sure you guys have that. They're going to get my code, which is going to get them into our game.
Awesome.
So if you've never played Kahoot before, go grab one of your kids, because they have 150 times. But you guys,
so much fun.
Yes, we got to get ready for Kahoot, because we're going to play that as soon as Heather's done. That is how you guys.
About done, yeah.
Yeah, that's how we're going to get somebody to win their free appraisal.
So we talked about appraisal contingencies. We've talked about loan contingencies and physical inspection real quick, just in case you weren't here earlier. Your appraisal contingency is something that you want to make sure that you leave in the contract. What it does is you're going to have an appraiser. You as a buyer pay for the appraiser to go out to the property. It's a neutral third party. They're going to tell you what the value of the home is from a neutral third party perspective. As lenders, we rely on that to ascertain the value of the home. You could buy a home for $700,000 if you want to, but it might only be worth $600,000. We as lenders need to know what is the true value of the property. Your appraisal contingency is in there such that if you agree to purchase a home for, let's say, $500,000 and the appraisal value comes in at maybe $495, you have some negotiating room with the seller. The value came in a little bit lower. We want to go back. We want to negotiate with the seller, maybe get that price reduced, maybe meet halfway. Maybe it's something that I don't really care. I'm just going to take it anyway because I absolutely love this home. It's my dream home. But you want to make sure it's in there so that you have that option. Loan contingency is just basically similar to appraisal contingency. It's in there to say that you definitely get that loan. Even though we pre-approve you for a home, sometimes something comes up in the middle of it. Oh gosh, the tax rate is higher than we were told. Somebody might lose a job or get a new job, or, whatever, things change. We want to make sure, or the appraisal doesn't come in, we want to make sure that you keep that loan contingency in there so that if you, for some reason, cannot get the loan, you have the option to cancel the contract. Your physical inspection contingency is similar. That's your home inspection. You want to make sure that you do hire a home inspector. They do not have to be a licensed contractor. Usually they're certified by some sort of board with the state. They know what they're looking for. They're going to ascertain the condition of the property for the buyer. They're going to tell them, what condition. Is there something that needs to be fixed, something that needs to be replaced? If it's something that's tremendous, like a roof, and you just don't have the money for it, and the seller says, so sad, too bad, we're not going to fix it, you have the option to cancel the contract and get that EMD back, your earnest money deposit back. Your termite report, it used to be something that the seller covered. In the last few years, it's become, what we consider a buyer inspection. They're generally $85 to maybe $150, depending where you're at, possibly a little bit more. Recommend you do them. A lot of people waive them. They can be costly. They can be anywhere from a couple $100, replacing patio beams, to tenting a whole house. I've seen as much as $25,000. So you really want to make sure that you keep that in there, and that you're not like surprised at the close of escrow. You've moved into the home and you see little shavings on the house, but you didn't do a termite inspection, and now you got $10,000 of repairs. Again, you can ask for, the seller to help you with that. So you want to make sure you keep that in there. Once you've done all of that, you've got your inspection done, you've got your appraisal done, you've got your loan, now you're going to go ahead and get your loan funded, and we're going to close escrow on the property, which is also known as recording the property. And your realtor is going to happily hand you your keys and say, congratulations on your new home, which is what we are all working for.
Right.
So,
right.
Most important part there.
Exactly. Yeah. All right. Perfect. So I think you're in escrow. So now what?
So you're in escrow. So the first thing you want to do, you and your realtor went out yesterday, you found the house that you wanted, you wrote an offer, you got it accepted. Monday morning comes, you need to contact your lender because your time frame starts now. And the lender is going to need every little part of that time frame. So you want to make sure that you contact your lender. Hey, Debbie, I found this perfect home over the weekend. I got in contract. Here's my realtor, or so-and-so found me the perfect home. Get the contract. We need that contract as the lender. We cannot move forward on anything until we have your contract. We need to know where you bought, the address, and all the terms in order for us to get your loan process going. And so once we get that going, we can go ahead and lock in your rate. Then we want to get out your disclosures that Debbie talked about earlier, telling you, how much you're going to owe, what your fees are. We're going to contact your escrow company. We're going to find out what your escrow fees are, what your title fees are, so we can give you the very best estimate on what you're, anticipating to close. You're going to want to get those signed. And then at the same time, we're going to order your appraisal for you. Super important, because appraisers can be a little backlogged. So once you get that offer signed, give us a call. Let us know that you got it signed. Sometimes depending on where we're at, if we've got you pre-approved, we can do really fast escrows, 14 days, 21 days, like with Chris. Sometimes it's a 30-day escrow, whatever works for you guys, but you do need to call the lender. Do not rely on escrow doing it. Do not rely on your realtor to do it. You need, to definitely do it. At the same time, and your realtor should guide you through this, you're going to want to set up your home inspection. Although the lender orders the appraisal, okay, we handle all that for you. You need to set up your home inspection. Sometimes your realtors will help you with that, get you in there on a day and time that work for you. I really, really, really recommend that you be there. I know a lot of people don't have time to be there. Find a home inspector that will work with you. You are buying a home. It is probably the most expensive thing you will ever invest in. Find out the condition of the home. Do not be surprised after you close escrow that something breaks or something leaks. Super important. All different home inspectors have different times available. They cover different things. Some inspectors look at roofs, some don't. Some look at sprinklers, some don't. Make sure that you have somebody that does what you need them to do. If they cover a pool, And they're all different prices too. So find somebody that's in your price range. Make sure that they're working for you. At the same time, you're going to wire the deposit into escrow. We just had a great question about that. So simultaneously, you're going to go ahead and work with escrow on how to get your deposit in, so that you can get that going. Let's see here. Oh, you can get it in. Like I said, the cashier's check, let me just kind of cover that. Most people will wire their funds into escrow. It's the fastest way. But work with escrow because some of them do take cashier's checks and everything else too.
What happened?
There we go.
What'd you do?
Nothing.
You went the wrong way.
No, I went that way and it went gone. It went gone. You like my words?
Yeah, you went the wrong way. All right.
There we go.
So
We're going to switch.
Yeah.
Oh my gosh. Okay, cool. Oh, look, there's us.
It is. There it is. There's the wine. This was supposed to be for the day, and that didn't end up happening, but that's okay. So this is the point where you guys are going to get to ask your questions. But before that, obviously, closing your loan, I had talked about you guys would have your closing disclosure. The closing disclosure does have to come out about 3 days prior to closing. It has to come out at least 3 business days prior to signing loan documents. So if you were in the middle of a transaction and you're supposed to close tomorrow and you have not signed a closing disclosure yet, you are not closing on time. So make sure you guys keep that in mind, but it will basically look exactly the same as your loan estimate. And if you are working with a really good loan officer, you should have already gone through those fees and asked your questions and feel pretty comfortable by the time that closing disclosure gets sent out to you. So this has been a little bit different workshop than what I had originally anticipated, since I thought we were going to have a bunch of people come in and you'd be here in person and sitting, kind of classroom style. And so what I usually do when I start a presentation is I say, you've got cards sitting on your desk and you've got, I always give everybody the, 3x5 index cards, and they've got pens and they can write all of their questions down as we move throughout the presentation. And then what we do is we actually pick up those cards and we then do a full Q&A of answering every single question at the same time, because it seems to help us get through the information, quicker. But because this was all online, I think it was a little bit easier for you guys to go ahead and start throwing your questions out there as we were moving throughout the presentation. So I'm really happy that you guys did that. I don't feel like we need to stop here right now and do that part. But we are at our final rally, our final raffle. This is where one person will win a free appraisal. So when you guys do get yourself pre-approved, get yourself out there into escrow, you are going to get a free appraisal paid to you by the Mortgage Mom. Now, obviously, this is only if you use the Mortgage Mom to do your loan. I cannot pay for your free appraisal if you go use a different lender. So I am going to throw that snippet out there for you. But we are going to play Kahoot. This is how you win. This is the best part of the entire day. It is a ton of fun. And this is kind of things that are pretty, you should know the answers to these things by this point. If we didn't give you the answers, I apologize. Make your best guess, because we've got $600 on the line right now.
I'm going to win.
You are not allowed to play.
I'm going to cheat.
You are not allowed to play. So anyway, one thing to keep in mind, I will talk about as I went through FHA. Minimum credit score for an FHA is 550. Most lenders will tell you 580. So make your very best bet. Conventional loan minimum credit score would be 620, but you will not get a very good rate unless you're over a 680. USDA does not actually have a minimum score requirement. But you guys are going to make your best guess, because this is going to be, I think, pretty easy, enlightening. If you don't answer it right, you'll know the right answer, which means that you're answering your own questions. And again, you've got a great option of an appraisal on the line here for you. So you guys got to go to Kahoot. It is kahoot.it. So kahoot.it if you've got it on your phone. A lot of people actually have like a phone app, but it's kahoot.it. We can see Mom on the Go is already on. Everybody else needs to jump on right now so that you guys can play, or she's going to be the immediate winner. But jump on there, and then we're going to start to go through the questions, and the winner at the end is going to get the free appraisals. So while you guys are getting yourselves logged in, the game pin is 79 506. While you guys are logging in, we're going to take a super quick break. And then when we get back, we will play the game. Hold tight. All right, so welcome back to Mortgage Mom Radio. This is the final for the appraisal. Who's going to win the free appraisal today? I didn't realize, I thought that I'd give you guys time to get into Kahoot, but I didn't realize. So it's Kahoot.it. So just open up Safari or Google or whatever you guys are on, Kahoot.it. Put in the game pin 79506 to play the game with us. I didn't realize that took the game pin off of your screen, so you guys couldn't all log in. So make sure that you guys get in there. We are going to start this in about, I don't know, I'll give you guys another 2 minutes. So let's see who else we can get in there. We've got
this is what happens when we drink alcohol.
4, 5, 6. We got 7 people in right now, and I can actually see that on we've got 16 people right now on YouTube. So I know that there are more of you guys that can get in here to play this game. It is a ton of fun. But I'll give you guys about 30 more seconds to jump in.
So if you've never played Kahoot before, and we did this in law school, yes, I went to law school, graduated, fun times. But the question's going to come up, and you have a specific time to answer. So, and you get points based on how fast you answer and if you get it correct. Super, super fun game. Yeah, just join in. It's absolutely fun. And there's some personal information.
There is, and we mentioned it. If you've been watching the show, we mentioned the answers in the show.
Yeah.
So just make sure you guys.
And Wednesday's show, we talked about a big one.
We did. But I brought it up today too, to make sure that anybody didn't listen to the show this weekend on radio, or they didn't listen to the YouTube, or they didn't listen by podcast, that
they got to go back and listen to my drama.
Right.
Gosh.
All right. So we're going to go ahead and get started. We've got a 1 in 8 chance right now of you winning. So this is pretty cool. So let's go ahead and Mikey, go ahead and fire her up. Here we go.
I'm going to win.
All right, Mortgage Mom Radio fun facts. Here we go.
Getting ready.
3, 2, 1. Faster you answer, the more you get. What is the weight of Debbie's new fee? 75, 3 pounds, 140 pounds, or 117 pounds? So you guys have to make your answers, your selections.
I love that picture.
She is about that big.
Yeah, she almost.
And I'm pretty sure that in today's show I said 150. So go with the closest answer to the 150.
You did yesterday on radio too.
I did. Go to the closest answer on 150. We put her on a diet. She was getting a little chubby. She's looking a little bit more like that horse. So the answer was 140 pounds. So here we go. Tracy is in the lead, 828. Manny's right behind. WMB is at 534. So here we go. Quiz number 2. What is the fastest route to homeownership? Apply for your roadmap, do nothing and hope for the best, try to win the lottery, or more move back in with your parents. That's pretty. Pretty self-explanatory. I think you guys can do it. Come on. Yep, there we go. Apply now for your roadmap. Learn what you need to do to get where you got to go. All right, we got Tracy in the lead still. WMB is right behind her, so let's see if we can't change this. We got like 3-4 more questions to go. Here we go. Quiz number. How many days do you have to apply for your loan to receive your free appraisal up to $500? So the fastest person to answer this gets the answer. If you guys apply for your loan with Mortgage Mom Radio within the next 7 days from today, you will actually get the opportunity to get up to $500 credited to you towards your appraisal. So I'm giving you the answer. 7 days.
I already said 10. I'm not going to win.
You can't play anyway.
I'm going to play. I'm playing in my mind as it comes up on the computer.
Watch me be wrong. And I actually said 5.
No.
And I didn't. I did say 7. Perfect.
Oh, somebody else said 10. See, they're with me.
There they go. All right. Look at Susan is fast moving up.
Dang.
Quick moving up. Justin, wherever you're at, we got to get you going. 1, 2. We got it. Here we go. Quiz.
All right, Justin,
Number
I'm
4.
gonna help you out.
All but which of the following is a benefit to homeownership? Security, pride of homeownership, income tax savings, or paying your landlord's mortgage. Yeah. All of which is a benefit to home. So basically you're answering which one doesn't work.
Correct.
Here. You're getting security, you're getting pride of home ownership, you're getting income tax savings. You are not having fun paying your landlord's mortgage.
No. I didn't even have to help out on that one.
All right. Susan is quickly approaching. Look at that. Tracy, you are in the lead. All right, here we go. Number 5. What is the minimum credit score for an FHA loan? So I said this earlier. Is it 560, 580, 600, or 620? Most lenders will give a loan at 580, although 550 is the actual credit score. And I do not have 550 on there because most need to get to 580. So make sure you guys are selecting the blue button. But if you knew the answer, you're in the lead. Oh, time's out. Here we go. Ooh, Mom on the go is moving her way up there. All right, we're getting close. Here we go. Number 6, what is the minimum credit score for a USDA loan? 620 or higher, similar to other programs. 500 or higher, no specific credit score. So USDA does not have a specific credit score. So I'm giving you guys that right now. Most of the time, you're not going to get the loan approved unless your credit score is above 620. So it is an algorithm with the way that the computer system works, but no specific credit score would be your answer.
That was a tough one.
It was.
Only 2 people answered.
It was.
Nice.
All right.
No change.
No change. Here we go. How do Debbie and Heather enjoy spending their weekends? Mani Petties, boating in Lake Havasu, shopping at Nordstrom Rack, or tent camping in Yosemite?
That last one always makes me crack up.
It does, because you will not find me in a tent. I
ma'am.
can tell you that. Mani Petties are nice.
Yeah,
they
but
are nice
for the weekend.
Yeah.
Like, I need more.
Yep. So Mikey, our cameraman and person doing all of this work, is the one actually with his arms up inside of the boat there.
Yep.
So you guys can see that is my boat, if that gives you guys any indication of which answer you should have selected. Oop, WMB is on the way up. All right, here we go. We're going to the next question. Question 8 of 12. Is it okay to bring your dog with you during property tours?
Oh, there they
True
are.
Or false? Those are my girls. There's
It is
the big
not
one.
recommended unless you have a service dog to bring an animal with you, because you never know if that homeowner is going to have an animal that's going to clash with your animal and not be safe.
Correct. So the answer would be false. False. All right, right, here we go. Mom on the go is moving up. Manny's kind of sitting right there. Susan. All right, here we go. 9 out of 12. What is the minimum credit score for a conventional loan? And I did give you guys this answer. So the minimum on a conventional loan is 620. It is not. It is much higher than the FHA minimum of 550. But most of the time, even with the 620, you're going to want to try to get to 680 for the pricing on a conventional loan. So keep that in mind.
Oh,
big shift. WMB, you coming up. Here we go. We're going into the next question. What do we got? We got like 10, 11, and 12, 3, 2. What is the minimum down payment for an FHA loan? And I am not even going to tell you guys this one because we did go into this at the beginning of the workshop. So is it 3%? Is it 3.5%? 5%? 10%?
Mixed board.
3.5%. 3.5% down. Oh, Tracy didn't move. All right, here we go. She looks like she's winning. What is the down payment for a VA loan? Okay, well, you guys, I think most people know that vets are not required to have a down payment. So 0% down would be the VA answer.
Yeah, we didn't really get into that because we didn't have any.
We didn't go through the VA. So I'm giving you guys answers as we go. All right, here we go. 12 out of 12. What is the minimum down payment for a conventional loan? And we did talk about this. So conventional, you can have a 3% down loan. The pricing, the interest rate, and the mortgage insurance might not be favorable or what you want. Maybe there's a better selection. But 3% down would be your minimum on a conventional loan. Here we go.
Ah,
Oh,
nice.
Susan took 3. WMB took 2. Oh, Tracy took 1. I love it. All right, guys. So remember, if you want your appraisal up to $500, Tracy just got an appraisal up to $600. It's probably going to be somewhere between 5 and 6 for a normal FHA or conventional loan. If you want a free appraisal, we are giving you a credit for that. If you do start your pre-approval loan application within the next 7 days, we would absolutely love to help you. Everybody on my team is here to make sure that we give you the very best of service, education, knowledge, referrals to the best real estate agents in the area where you're looking to purchase. Please reach out. That is what this show is for. We are here to help you guys in any way that we can. We just want to make sure that we're educating you for the best possible outcome. Getting you there to homeownership is so very important. So Wendy said, shoot, the game is not letting me select times me out. Oh, I'm so sorry, Wendy. That is terrible. I'm sorry that that happened to you. But we will reach out to you, Wendy, if you you have actually been working us for a really long time. So we'll make sure that you get taken care of, even though you couldn't play the game. And we hope that you guys all have a fantastic rest of your Sunday. Feel free to share today's workshop with anybody that you know who's been thinking about purchasing a home, who you feel that this was very valuable information to get them on the right foot. And we'd absolutely love you guys to give us a call our team, and work with us for your next purchase. It's 844-935-3634. And we hope that you guys all have a lovely rest of your Sunday afternoon. We'll talk to y'all real soon. Bye-bye.
Debbie Marcoux, licensed by the Department of Financial Institutions and MLS ID 237926. Also licensed in Arizona 0941504, Florida LO 76508, Georgia 69178, Idaho, Nevada 57237, Oregon, Tennessee 184373, Texas, Washington MLO 237926.
She's the mortgage mom. She can get things done when you're in need and don't know where to go. Pick up the phone and call mom.